Please like, share, and subscribe. Wishing you happiness and good luck every day.
All right, let's get right into it. Today, we're going to pull back the curtain on one of the most powerful and time-tested strategies in all of finance, value investing. We're going to build, piece by piece, the exact framework that legends from Benjamin Graham all the way to Warren Buffett have used, and we'll be using the fantastic work of Greenwald and his team as our roadmap. So let's jump in.
First things first, you have to get your head around the idea that value investors are playing a completely different game than almost everyone else. On one side, you've got the chaos of market speculation. It's all about guessing which way the price will wiggle tomorrow, chasing trends, following the herd. But on the other side, you have business investing. Here, you're not buying a stock ticker, you're buying a fractional ownership in a real, living, breathing business. And the only thing that matters is what that business is actually worth, totally separate from its moody price swings.
So here's our game plan for today. We're going to walk through 6 key ideas to really build out this entire framework. We'll start with why it even works in the first place. Then we'll construct a valuation method step by step. We'll tackle the tricky subject of growth, get inside the mind of a great investor, and then finally we'll talk about where you can actually go to find these opportunities.
Okay, let's kick off with the big question. Does any of this actually work? Well, the evidence over the long haul is pretty overwhelming. For decades, study after study has shown the same thing. A portfolio of boring, cheap-looking stocks has consistently beaten the pants off the glamorous, exciting, high-flying stocks. It's one of the great puzzles in finance, really. And a lot of it just comes down to human nature. We tend to overpay for a good story and completely ignore the steady, profitable, but maybe less exciting businesses.
This right here really gets to the heart of it. You see, most people are totally obsessed with what Benjamin Graham famously called Mr. Market. Just imagine he's your business partner, but he's a total manic depressive. One day he's euphoric and offers to buy your shares for a crazy high price. The next day he's in a panic and offers to sell you his for pennies. Now most people try to outsmart his moods. The value investor, they just ignore the noise. They've done the homework, they know what the business is worth, and they know that sooner or later, Mr. Market's wild prices will come back to reality.
So, how do we find that real value? Where do we start? Well, we start on solid ground. We begin with the most concrete, reliable thing possible, the company's assets. This is step 1, our conservative foundation. We're not trying to predict the future here. We are just analyzing what exists right now. I want you to think about a company's total value as being made of 3 distinct layers, or slices. In this first one, asset value, it's our bedrock. It's the foundation of the whole thing. It answers one simple, powerful question. If this company disappeared overnight, what would it cost to rebuild it from absolute scratch today? It's tangible, it's conservative, it's our starting point.
Now here's a really critical point. This is not the same as book value that you see on a balance sheet. No. Asset value is all about the realistic, current reproduction cost. So for instance, a company might own a piece of land they bought for $1 million back in 1975. That's its book value. But what would it cost to buy that same piece of land today? Maybe $50 million. That's its reproduction cost. We do this for everything, the factories, the equipment, the inventory, and then we subtract everything the company owes. That gives us a true conservative net worth.
And the process itself, it's pretty logical when you break it down. You grab the balance sheet, but you don't just take the numbers at face value. You have to put on an appraiser's hat. You adjust everything to reflect today's real-world costs. That land might be worth way more. Some old specialized machinery might be worth way less. Once you have a realistic number for everything the company owns, you subtract everything it owes. Whatever is left over, that's your net asset value.
Okay, so we've poured the foundation with our asset value. Now we can move up to the next layer. We're going to shift our thinking from the company as just a collection of stuff to seeing it as a living, breathing, cash-generating machine. And this is where we calculate what's called its earnings power value.
So here's our second slice of value, the EPV. This is all about what the company's profitability is worth. But, and this is a huge but, here's the discipline. We value this stream of earnings under the incredibly strict assumption of zero future growth. Why? Because it stops us from getting seduced by exciting stories about the future. It forces us to value only what is real, tangible, and sustainable right now.
To calculate the EPV, we have to take a company's reported earnings and basically clean them up. We smooth out the natural ups and downs of the economy. We strip out any one-time flukes or accounting games.
Our goal is to find a normal, sustainable number for the cash it can produce year in, year out. Then we ask a simple question. What is a cash stream of that size, lasting forever, but never growing, worth to me today? It's like valuing a bond that pays a coupon forever. That's what we're doing for the whole business.
Now this is where the framework becomes so incredibly powerful, because now we can compare our first two slices, and it acts like a diagnostic tool. If a company's earning power is actually less than its asset value, well, that's a huge red flag. It means the management team is destroying value. They're not getting a good return on the assets they have. But if the two numbers are roughly the same, that's actually what you'd expect in a normal competitive business. It tells you your valuation is probably in the right ballpark. And now finally we get to talk about growth. But in the world of value investing, growth is treated with deep, deep suspicion. You see, most of the time, for most companies, growth actually destroys value. It doesn't create it. Value is only created when that growth happens inside a protected economic fortress.
This brings us to our third and final slice of value. This is where the real magic can happen, but it's also the most dangerous and speculative part. Growth only adds to the company's value if, and only if, that company has some kind of durable competitive advantage, what investors like Buffett call a franchise or a deep economic moat. Without that moat, growth is just running faster on a treadmill.
Just think it through logically. For a company to grow, it has to invest more money in new factories, more inventory, whatever. Now, if it's in a brutal dog-eat-dog industry, any new money it invests will only earn a pathetic commodity-level return. No real value is created. But if that company has a killer brand people love, or a patent nobody can copy, or a massive cost advantage, then every new dollar it invests earns a super high return. That is when you get an explosion in shareholder value.
And this little table just says it all, doesn't it? Look at Company A. It invests $100 million and earns a 10% return, which is exactly what its money costs. Net result? Zero value created. They've just been spinning their wheels. Now look at Company B. It's protected by a franchise. It invests the exact same $100 million, but it earns a 25% return. That single investment creates a staggering $150 million in new value. That is the difference between an average business and a truly great one.
So, okay, we have the framework, we know how to value a business. But you know what? That's the easy part. The formulas are simple. The real secret, the thing that separates the legends from everybody else, is all psychological. It is all about having the right mindset.
You just gotta love Buffett's wisdom. This is such a profound warning against arrogance. What he's saying is, even a genius CEO can't save a fundamentally terrible business. The value investor understands that it's infinitely better to own a fantastic business that a fool could run than a terrible business that requires a genius just to stay afloat.
And this right here is such a critical idea. Value investing is not about being the smartest person in the room who can figure out incredibly complicated situations. It's about having the wisdom to avoid those situations entirely. It's about looking for simple, easy-to-understand businesses where the odds are just stacked in your favor. As Buffett says, look for the 1-foot hurdles you can easily step over. Don't go looking for 7-foot bars to clear.
And it really all comes down to this simple but incredibly powerful checklist. First, is it a business you can actually understand? Stay inside your circle of competence. Second, is it a good business with a durable moat? Third, is it run by people you can trust? And only after you've checked those 3 boxes do you even bother asking the 4th question. Is the price an absolute steal?
And that attractive price is what gives you the single most important concept in this entire philosophy, the margin of safety. This is your ultimate protection. It's the gap between what you calculate the business is worth and the price you actually pay for it. Think of it like an engineer building a bridge. If the bridge needs to hold 10 tons, they design it to hold 30. That extra capacity, that's your margin of safety. It's the cushion that protects you when you make a mistake or just get unlucky.
So this brings up the obvious question. If this all makes so much sense, where do you actually find these amazing opportunities? Where are all these great companies selling for cheap? Well, the key is you have to fish where the other boats aren't going.
Let me tell you, you're almost never going to find true value in the hot, popular stocks everyone is talking about. Value hides in the dark corners of the market. It's in the boring companies nobody finds interesting. It's in companies that are just too small for the giant Wall Street funds to even look at. It's in weird situations like corporate spin-offs that big institutions just sell without thinking, or it's in companies or entire industries that are drowning in bad news and irrational fear. Value investors are scavengers. They thrive on that kind of neglect and panic.
And that really brings us to the final, most important point. The whole framework we've laid out today, it's logical, it makes sense, it's simple, but it is not easy. Because in the end, the biggest challenge isn't doing the math. The real challenge is in your own head. It's having the stomach, the discipline, the sheer emotional fortitude to stand apart from the crowd. So the real question you have to ask yourself is one of temperament. Can you really bring yourself to be greedy when everyone else is terrified, and be fearful when everyone else is euphoric?
So, what if I told you that the stock market isn't some complex machine, but is actually a moody, totally unpredictable business partner? One day he's on top of the world, the next he's in a complete panic. Well, that's the whole idea behind one of the most powerful investment strategies ever created: value investing. Today, we're going to break down how you can deal with this Mr. Market and actually use his wild mood swings to your advantage. Look, to really get value investing, you first have to understand who you're dealing with. And Benjamin Graham, who's basically the father of this whole philosophy, gave us the perfect way to think about it: Mr. Market. He's not some rational calculator, he's your manic depressive business partner. Some days, he's euphoric. He'll buy your shares at any price you name. But other days, he's absolutely terrified and will practically give you his for pennies on the dollar. And that idea, that character, well, that sets the stage for everything that follows. All right, here's our game plan for this explainer. First up, we'll get properly introduced to this Mr. Market fella. Then we'll lay out the value investor's actual blueprint, see how it stacks up against other ways of doing things. And, this is the big one, check the proof to see if it even works. After that, we're going to completely redefine what risk really is. And finally, we'll get into the essential mindset you absolutely need to pull this off. Okay, so let's dig in and get to know this Mr. Market a little better. Because let me tell you, if you don't understand the game he's playing, you are almost guaranteed to lose yours. Just imagine for a second that every single morning, some guy knocks on your door and offers to buy your house. Some days he's feeling great, offering you double what it's worth. Other days he's in a total panic, offering you half. That's Mr. Market, but for stocks. His prices are all over the place, and they often have very, very little to do with the actual value of the business you own. And right there, in that gap between his frantic price and the real underlying value, well, that's where value investors find their gold. So if Mr. Market is the emotional, chaotic problem, then value investing is the rational, disciplined solution. It's a mental framework, really, a way of thinking and acting that basically insulates you from his wild mood swings. At its very heart, value investing is built on 3 really powerful beliefs. First, you just have to accept that market prices are often driven by fear and greed, not by cold, hard logic. Second, you have to trust that every single business has a real underlying value. We call it intrinsic value. That's way more stable than its day-to-day stock price. And the third, well, this is the magic ingredient. You have to believe that if you can buy a piece of that business for way, way less than it's truly worth, you're setting yourself up for some serious wins down the road. And that leads us to maybe the single most important concept in all of value investing: the margin of safety. It's just the buffer, right? The gap between what a business is actually worth and the price you pay for it. Graham's famous line says it all. He wanted to buy $1 for 50 cents. That 50-cent difference, that's your protection. It's your cushion against being wrong, against bad luck, or just against Mr. Market having an even worse day than you thought possible. Now, this isn't just some vague philosophy. It's a step-by-step process. As you can see right here, it's a repeatable discipline. It all starts with selecting some potential investments. Then you do the real work, the heavy lifting of figuring out what they're truly worth. Next, and this is non-negotiable, you insist on that margin of safety. And only then, after those first 3 crucial steps, do you even think about deciding how much to buy, and eventually when you're going to sell. Okay, but let's be honest, almost everyone says they're looking for a bargain. So what really makes a true value investor different from everybody else in the market? Let's draw some really clear lines in the sand here. This chart here kind of lays out the entire investing universe. You see, on one side, you've got your short-term traders. They're glued to price charts trying to predict the next wiggle. On the other, you have fundamental investors who look at the business itself. But look closely at that split within the fundamental camp. Value investors are playing a very specific, very long-term game that's all focused on one thing: levels.
And this table, this right here, this gets to the absolute heart of it. You see, most investors are focused on change. They're trying to predict the future. They're asking, what news is going to come out that'll make this price go up? They buy a stock at $50 hoping it'll go to 60. A value investor, they focus on the level. They ask a totally different question. Is this stock priced at $50 today actually worth $100 right now? They care about the value today, not the forecast for tomorrow. And believe me, that is a profound difference in perspective.
All right, so the theory sounds great. I mean, it's logical, it's disciplined, it makes sense. But hey, this is investing, not a philosophy class. The only thing that really truly matters is the bottom line. So let's get to the proof and see if this thing actually works.
This really is the million-dollar question, isn't it? After all that hard work, calculating intrinsic value, waiting patiently for Mr. Market to throw you that perfect price, are the results actually worth the effort? Well, thankfully, the academic and historical data on this is pretty darn clear. So for decades now, researchers have tested this using a dead simple mechanical process. They take the entire stock market, they sort all the stocks from cheapest to most expensive using a simple metric like price-to-book ratio. Then they form portfolios of the cheap stocks and they just hold them for a year. That's it. No genius, no deep analysis, just a simple rule. So what do you think happens? The results are, well, they're staggering. For nearly a century, going back to the 1920s, simply buying the cheapest stocks has consistently beaten the market average by 3 to 5% per year, on average. Now I know that might not sound like some huge headline-grabbing number, but over an entire investing lifetime, the incredible power of compounding turns that small edge into an absolute fortune. Now, the immediate pushback you hear to numbers like that is always the same thing. Sure, okay, you got higher returns, but you obviously must have taken on way more risk to get them. But here's the thing. Value investing has a completely different and I think much smarter way of looking at risk. This is the standard line you get from academia, right? There's no such thing as a free lunch. A higher return must mean you took on higher risk. But what if the way we all typically measure risk, those squiggly lines of price volatility on a chart, what if that's completely wrong? So here's the real kicker. When you actually go and study these value portfolios, they almost always turn out to be less risky by most common sense measures. They tend to fall less when the market crashes. And why is that? It's simple. They already had that margin of safety built right in. They were already cheap to begin with, so there was just less air in the balloon to pop when things got ugly. Warren Buffett gives the absolute perfect example of this. Back in 1973, you could buy the entire Washington Post company for $80 million. But Buffett knew it was worth at least $400 million. So he asks this question. If the stock price had then dropped, so the whole company was worth $40 million, would the stock be more risky? Wall Street, totally obsessed with volatility, would scream yes. But Buffett would say absolutely not. The risk would actually be lower because his margin of safety would now be gigantic. See, risk isn't a squiggly line on a chart. Risk is the danger of permanently losing money because you paid too much for something. So we've got the theory, we've got the proof, but there's one last piece to this puzzle. And frankly, it's the hardest part of all. It's not about spreadsheets, it's not about formulas, it's about your temperament. So what does it really take to be a successful value investor? It really comes down to 3 things. First, you need the humility to know what you don't know and to stay inside your circle of competence. Second, you need the wisdom to tell the difference between a true hidden gem and what's just a cheap piece of junk. And third, and this is the one that gets almost everybody, you need almost superhuman patience to just wait and wait and wait for the right opportunity to come to you. I absolutely love this analogy from Buffett. He says, in the stock market, you're a batter, but there are no called strikes. You don't have to swing at every pitch. You can just stand there at the plate and watch hundreds, even thousands of ideas go by. Bad pitches, fast pitches, weird pitches, and nothing happens. You're just waiting for that one perfect, slow, fat pitch right down the middle of the plate. And that's your job. To wait for the obvious, easy opportunity, and then, and only then, do you swing for the fences. And so that brings us to the final question, really, and it's the one that only you can answer. The intellectual case for value investing, I think, is crystal clear. The historical evidence is incredibly compelling. But a winning strategy is totally useless if you don't have the right mindset to actually execute it. So the real question you have to ask yourself is this. Do you have the patience to wait for that perfect pitch?
So let's talk about an investment idea that's as old as the markets themselves, but one that most people find incredibly difficult to actually do. We're going to go hunting for hidden value. If you've ever looked at the market and thought, how does anyone find a real bargain in all this noise? Well, this is for you. We're diving into a time-tested way of thinking that deliberately swims against the current. All right, so here's how we're going to break this down. First, we're going to look at the massive, overwhelming universe of stuff you could invest in. Then, we'll talk about 3 simple, powerful filters to cut right through that chaos. That's going to lead us to something called the value anomaly. It's a huge puzzle in finance. We'll dig into why that anomaly exists, where to actually find these hidden gems, and finally, wrap up with the most important part, what happens when the real work begins. Okay, let's kick things off with a problem that I guarantee every single person listening has felt: the sheer number of choices. I mean, where do you even begin? Just think about it for a second. You've got currencies, you've got commodities like gold and oil, government bonds, corporate bonds, thousands and thousands of mutual funds. You can even invest in collectibles. It is a huge, loud, confusing universe. And you know what? Trying to be an expert in everything is a surefire way to fail. So, what do? We have to simplify. We have to draw a circle around one specific piece of territory and just master that. For our purposes, we're going to ignore all that other stuff and focus on just one thing: individual company stocks, equities. Because this is where the strategy we're talking about really comes to life. It's about figuring out what a business is actually worth. All right, so we're looking at stocks. Great. Now what? How do we sort through the thousands of them to find the ones worth our time? Well, decades of research have given us a pretty powerful toolkit. 3 specific filters that are designed to separate that signal from all the noise. You know, academics have tested just about every strategy under the sun, but it all kind of boils down to 3 main ways of sorting stocks. First, you can look at the fundamental health of the business itself. Second, you can look at its price history, what the stock has been doing lately. And third, you can use ratios that connect that price back to the business. So let's take these one by one. Okay, now this is where things get really interesting, and honestly a little backwards from what you'd expect. Common sense tells you to buy the excellent companies, right? The ones with amazing growth, huge profit margins. But the data, over and over again for decades, shows the complete opposite. It turns out that portfolios of so-called value companies, the ones with ugly fundamentals like slow growth or thin profits, have actually produced much, much higher returns. It sounds crazy, but in search of disaster has beaten in search of excellence. So our second filter is all about price history, or what people call momentum. And here's the big twist. In the short term, let's say about a year, momentum actually works. Winners do tend to keep on winning. But if you stretch that timeline out to 3 years or 5 years, this incredibly powerful force just takes over. The stocks that were flying high fall back to earth, and the stocks that were in the gutter tend to rise up. That force is called reversion to the mean. So what is reversion to the mean? Well, it's basically a fundamental law of statistics. The source material uses a fantastic analogy. Think about really tall parents. Their kids are probably going to be tall, right? But on average, they probably won't be taller than their parents. If they were, we'd eventually have a world full of giants. Things naturally pull back toward the average. And it's the exact same with stocks. Trees don't grow to the sky. Extreme performance, whether it's good or bad, just doesn't last forever. And that brings us to our third filter, which is probably the most famous one: value ratios. This is where you directly compare a stock's price to what you're actually getting. Things like the price-to-earnings ratio, how much you pay for $1 of the company's profit, or the price-to-book value ratio. And the results here are just crystal clear. Time after time, value stocks, the ones that are cheap on these metrics, have absolutely crushed the expensive glamour stocks. The less you pay, the more you get. It's that simple. And there's one more critical piece to this whole puzzle: the size of the company. The data is pretty undeniable on this. Over the long run, stocks of small companies have, on average, outperformed stocks of large companies. And here's the key part. This size effect is totally separate from the value thing we just talked about. So now the picture's getting clearer, right? We're hunting for companies that are cheap, maybe a little unloved, and very often on the smaller side. Okay, let's just hit pause for a second. We've just laid out pretty compelling evidence that cheap, small, kind of boring stocks have historically been the winning formula. And that leads to a massive, multi-billion-dollar question. I mean, seriously, think about that.
We live in a world where markets are full of incredibly smart, highly paid people, all looking for even the tiniest edge. An opportunity this simple and this obvious just shouldn't exist. The moment it's found, everyone should pile in, bid up the prices of the cheap stocks, and poof, the advantage should disappear. But it hasn't. For decades, it's still there. This is what economists call an anomaly. It's a puzzle.
So why? Why does it stick around? Well, the easy answer you'll often hear is that these stocks are just riskier. But the data doesn't really support that. In fact, in a lot of cases, these value stocks have been less volatile. The real answer is simpler. It's more powerful, and it's a lot more human. It's not about risk. It's about bias.
And this bias isn't just one little thing. It's a three-headed monster that systematically makes investors pay way too much for the exciting winners and way too little for the boring losers. It's literally baked into the system, in the structure of big institutions, in the career goals of the people running them, and, well, in the hardwired psychology of you and me. First, let's talk about the big institutions. A fund that's managing, say, $50 billion, they literally cannot invest in a tiny $50 million company. It's just not worth the paperwork. Plus, there are rules that stop them from owning a huge chunk of any one firm. So what happens? A huge part of the market, the world of small companies, is just structurally ignored by the biggest players. A perfect example is a corporate spinoff. A big company gets rid of a smaller division, and the big funds that get those new shares often sell them immediately, not because it's a bad business, but just because it's too small for them. Now let's talk about the managers of those big funds. You have to understand, their main goal often isn't just to get the absolute best return. It's to keep their high-paying job. And the safest way to do that is to look like everybody else. This is all captured in that brilliant old saying, you're not going to get fired if you own Apple and it has a bad year because everybody owns Apple. But if you take a chance on some weird, obscure, beaten-down company and that goes wrong, you look like an idiot. Your career is on the line. This creates a powerful and frankly rational incentive to just run with the herd. And finally, we have to look in the mirror. Our own brains are wired with these glitches that get in the way. We all suffer from recency bias. We put way too much weight on what just happened, assuming that today's hot stock is going to be hot forever. And even more powerful is loss aversion. Psychologists have shown we feel the pain of a loss about twice as much as the pleasure of an equal gain. That feeling in your gut makes you avoid stocks that have gone down. They feel tainted, like failures, even though that very drop might be what creates the opportunity. Okay, so we get it. The market is full of these biases. We understand why the opportunity exists. So the next logical question is, where does it exist? Where are the contrarians' hunting grounds? Well, first, value often hides in plain sight with the boring and the obscure. I'm talking about a company that makes something essential but totally unglamorous. They've been doing the same thing for 50 years. There's no exciting story, no big media buzz. And because there's no story, Wall Street analysts don't bother covering it. And because it's not covered, the big funds don't even know it exists. It's just flying completely under the radar. And the second hunting ground, well, this one is even more contrarian. This is the land of the undesirable and the discarded. We are talking about companies coming out of bankruptcy, entire industries that everyone has given up on for dead, companies facing a scary lawsuit, or stocks that have just been absolutely crushed for years. The amount of bad news creates this emotional stampede for the exits, and that can push prices down to just ridiculously pessimistic levels, creating amazing bargains for anybody who has the stomach to go look. So we have our filters, we know where to hunt. It almost sounds easy, doesn't it? But, and I can't stress this enough, this is not a shortcut. This is the most critical point of the whole thing. This is the key. Using these filters, looking for small, cheap, unloved companies, that doesn't give you the answer. All it does is give you a manageable list of potential candidates. It gets you to the starting line. The real, difficult work of valuation, of actually digging into a business and figuring out what it's worth, that begins after you've run the screen, not before. This is just the map that shows you where to start digging for treasure. You know, when you boil it all down, this whole approach is built on one thing, being willing to go against the grain. It's psychologically difficult. It's uncomfortable to buy what everyone else is selling, and it requires patience when everyone else is chasing fast money. The very human biases that create these opportunities are the same ones that make them so hard to take advantage of. So the final question is really for you. Now that you know where to look, are you actually willing to go against that crowd to find what they've overlooked? So how do you figure out what a business is really worth? I'm not talking about its stock price today. I mean its true, deep, intrinsic value. You know, it's the central question for any serious investor. And today, we're going to see why the most common answer, the one they teach in every business school, might just be a dangerous solution. Let's pull back the curtain.
We're kicking things off with a legendary Charlie Munger for a reason. He's basically warning us that precision can be a trap. We love the comfort of a single calculated number, right? But he's forcing us to ask a really crucial question. Are our fancy financial models actually giving us real insight, or are they just giving us a false sense of security?
So here's our game plan for today. First, we'll get a handle on this whole hunt for true value. Then, we're going to put the standard formula under a microscope and see exactly where the cracks start to show. After that, we won't just leave you with the problem. We're going to rebuild a much stronger framework from the ground up, piece by piece. And by the end, I promise you'll have a completely new way of looking at the relationship between what a company is worth and what you're paying for it. You know, the whole idea behind value investing is this core belief. A company's stock price is not its value. It's just not. Think about it. The market is like a pendulum, swinging wildly between euphoria and despair. The true investor's job is to just tune out all that chaotic noise and become an appraiser, figuring out what the business itself is worth, completely separate from its fluctuating price tag.
So, what is this intrinsic value we're talking about? Well, think of it like this. It's the price a perfectly informed buyer would pay if they knew absolutely everything about the company's future. Now, of course, we don't have a crystal ball. So our job as analysts is to close that knowledge gap as much as we possibly can through careful, fact-based investigation.
Okay, so how does Wall Street try to find this magic number? Well, the go-to method, the one they teach everywhere, is the present value calculation. The idea is pretty simple. A business is worth the sum of all the cash it will ever generate, just discounted back to today's dollars. It sounds so logical, so precise. Almost scientific, doesn't it? The process looks really straightforward. You project a company's cash flows out for, say, 10 years. Then you pick a discount rate to account for risk. And then, and this is the big one, you slap a terminal value on it to represent everything from year 11 into infinity. You add it all up, and voila, you have your intrinsic value. So clean, so neat. But there's a huge problem lurking under the surface. And here's the problem. This entire beautiful, precise-looking calculation, well, it rests on a foundation of sand. The precision of the math is completely destroyed by the wild uncertainty of the numbers we're plugging into it.
I mean, let's just be honest with ourselves for a second. Can anyone really know what a company's profit margins will be in a decade? Or who its competitors are going to be? Heck, projecting out a couple of years is hard enough. Projecting 10 years into the future is, as the source material calls it, heroic, not to say foolhardy. It's basically financial science fiction. Now, check this out, because this is where it gets really interesting. Let's look at the math for that terminal value, which, by the way, is often the biggest piece of the whole valuation. So in this base case, we assume an 8% cost of capital and a 4% growth rate forever. The formula spits out a multiple of 25. Okay, seems reasonable enough, right?
But watch what happens when we just tweak these numbers. Numbers we are literally just guessing at. If we're just 1% more optimistic about our assumptions, boom, that multiple doubles to 50. And if we're just 1% more pessimistic, it collapses to under 17. Let that sink in for a second. A tiny, tiny shift in a wild guess creates a massive 3-to-1 swing in our final value. This isn't precision, it's a total mirage. And this just nails the core flaw, doesn't it? You might have a pretty decent handle on this year's earnings. That's your accurate information. But the moment you add these wild, speculative guesses about the year 2035, you corrupt the entire calculation. The good, reliable data gets completely contaminated by the bad, and the result is just, well, it's unreliable.
Okay, so if that whole model is built on sand, what do we do? Is there a better way? You bet there is. The pioneers of value investing, Benjamin Graham and David Dodd, they proposed an alternative. And their framework is built on a really simple, powerful idea. Separate your information by how reliable it is. Start with what you can know today and treat the uncertain future with the healthy skepticism it deserves.
And this visual here shows the idea perfectly. Instead of throwing all our data, the reliable stuff and the purely speculative stuff into one big blender, we're going to build our valuation like a pyramid. We start with a foundation of concrete facts, the company's actual assets, and only then do we carefully add the less certain layers on top of that. All right, so let's get our hands dirty and dive into the details of this ground-up approach. We're going to break down the 3 fundamental slices of value.
First, asset value. Second, what's called earnings power value. And then finally, the most elusive one, the value of growth. So the first and most reliable slice is asset value. This has nothing to do with the future. It's all about right now. We look at the company's balance sheet. If the industry's doing okay, what would it cost to reproduce all these assets, the factories, the inventory, the brands, from scratch today? This gives us a bedrock valuation, a number that's grounded in physical reality, not in future hopes and dreams. The next slice up is all about the present. We're going to ignore future growth for just a moment and ask a really simple question. Based on its operations right now, what is this business's sustainable, repeatable earning power? We strip out any accounting weirdness, any one-time charges, and we smooth out the highs and lows of the business cycle to find the true underlying profitability of the company as it stands today. And now we arrive at the third and final slice, the value of growth. Now, this is the element that standard models are obsessed with, but here we're going to isolate it and treat it with extreme caution. We start by asking a crucial question that honestly most people just skip right over. Does this company's growth actually create any real value for its shareholders? And here's the punchline. Growth is not automatically valuable. See, if a company is operating on a level playing field with no real competitive advantages, the investment required to grow just eats up all the potential returns. Growth only creates real, durable value when a company has a franchise, a sustainable competitive advantage, what Warren Buffett calls a moat, that allows it to earn returns well above its cost of capital. But here's where this framework gets really powerful. Its real power isn't just in spitting out a number. It's in what the relationship between these different slices tells us about the company's strategic position and its overall health. By comparing them, we can actually diagnose the business. And this chart just lays it all out beautifully. Look, if a company's earnings power is less than its asset value, something is wrong. It's a red flag, either poor management or a really sick industry. If they're about equal, you're probably looking at a decent but average competitive business with no real edge. But if that earnings power is substantially higher than the asset value, now that is the signature of a great business, a true franchise. So let's just boil this all down. What's the big picture? First, standard valuation models are dangerously sensitive to assumptions about a distant, unknowable future. A much better approach is to build value in layers, starting with the most reliable information we have, assets and current earnings. And the relationship between these layers reveals a company's true strategic reality. And most importantly, always remember that growth is worthless unless it's protected by a durable competitive advantage. Which leaves us with a final thought to chew on. Everyone on Wall Street is completely obsessed with trying to predict the next 10 years. They build these incredibly complex models to forecast the future. But maybe, just maybe, the true secret, the real edge in investing, isn't about seeing the future more clearly than anyone else. Perhaps it's about understanding the present more deeply. All right, let's dive in. Today, we're essentially becoming financial detectives. We're going to look past the official numbers, the stuff a company puts on paper, to figure out what it's really worth. This is all about the art of asset valuation. And trust me, it's like a treasure hunt for a company's hidden value. So it all boils down to this one question, right? What is a company really worth? Now, if you look at the official financial statements, you'll see something called book value. But, and this is a big but, that number is often just the first page of a much deeper, more interesting mystery novel. It's just the start of the story. And this leads us right to the central conflict of our whole investigation. It's a tale of two different values. On one side, you've got book value. That's what the accountants say, and it's based on what the company paid for stuff way back when, sometimes decades ago. But on the other side, you've got the prize we're hunting for. It's intrinsic value, which we're going to define as its reproduction cost. In other words, what would it actually cost a competitor to build this exact same business from the ground up right now, today? So here's our game plan. We're going to start by looking at how you value a company that's in trouble. Then we'll flip the script and look at a healthy one. We're going to decode the balance sheet, which is where all the clues are hidden. Then we'll apply everything we've learned to a fascinating real-world case, and we'll wrap it all up with the final, crucial clue every investor needs to know. Okay, first up, let's look at a company through what I call the liquidation lens. See, the way you value a business depends completely on the health of the industry it's in. And if that entire industry is a sinking ship, you have to ask a totally different set of questions. In that worst-case scenario, we use something called liquidation value.
This isn't about what the assets are worth as part of a running business. Nope. This is about what they'd get in a fire sale if the doors were closing for good. Think scrap metal prices, pennies on the dollar. It's the valuation you use when you know there's really no future for the company or the industry. Let's look at a quick example. For this made-up company, In the Red, Inc., cash is cash. That's worth 100%. But the accounts receivable, that's money customers owe them. You have to take a haircut on that. I mean, if a company's going under, are all its customers going to pay up? Probably not. So let's say you get 85 cents on the dollar. And the inventory? If it's a bunch of old, unsold widgets, you might be lucky to get 50%. You can see how fast that liquidation value drops well below what's on the books.
Okay, but enough doom and gloom. What about a healthy business in a good industry? This is a way more common situation and honestly a lot more interesting. Here, we're not planning a funeral. We're drawing up the blueprint for a competitor to copy the entire operation.
This quote just nails it. This is our new guiding light. We're not asking, what's this stuff worth for scrap anymore. The only question that matters for a healthy company is this: what would it cost someone right now to replicate this entire business from scratch? You answer that and you found its true economic value.
All right, with that idea as our North Star, it's time to roll up our sleeves. We're diving into the balance sheet. This is the heart of the investigation, going line by line, hunting for clues that will lead us to that reproduction cost. And this is where the real detective work kicks in. Think about it. A company might have a piece of land on its books for the price it paid back in 1965, which was basically pocket change. But if that land is now in a booming part of town, its real-world value is massive. A factory might be written down to zero on the books, but because of inflation and its prime location, it could cost a fortune to build another one just like it. On the flip side, old equipment might actually be a liability if new technology is way more efficient. The book value is just a hint, a starting point. Now we get to one of the trickiest, most misunderstood clues on the balance sheet: goodwill. Basically, when Company A buys Company B, any amount it pays over the fair value of B's physical assets gets recorded as this weird, intangible thing called goodwill. But the question is it a real asset? And here's the thing you have to understand. Not all goodwill is the same. Far from it. The goodwill connected to Coca-Cola's brand is incredibly valuable. I mean, think about what it would cost to build a brand that powerful from scratch. Billions, maybe trillions, and decades of work. That's a real asset. But if a company just messes up and overpays for another business that doesn't work out, the goodwill from that deal is totally worthless. It's just the ghost of a past mistake, a red herring in our investigation. And this, my friends, is where it gets really exciting. Some of the most valuable assets a company has don't even show up on the balance sheet at all. Accounting rules just don't have a spot for them. But a good financial detective, they know exactly where to look.
So how do we find these invisible treasures? Well, first, you look at R&D. Think of a pharmaceutical company. How many years, how many billions of dollars would a competitor have to spend to even come close to their portfolio of drugs and patents? That is a huge hidden asset. Second, what about their customer base? You can literally calculate how much it cost in marketing and sales over the years to build that loyal following. A new guy starts at zero. And finally, you have to value things like government licenses or exclusive rights. Those are powerful moats that can be incredibly valuable.
Okay, theory is great, but let's put our new skills to the test with a real-world case. This is the mystery of the Hudson General Corporation, and it is a fantastic puzzle of hidden value. So here's the crime scene just as it appeared to the public. This is the company's official balance sheet. It shows a total net book value of about $68 million. But a good detective's eyes are immediately drawn to one line. See that? Interest in HLLC subsidiary, valued at only $22 million. For the company's main business, that seems suspiciously low. That, right there, is our first big clue that something is off. And now for the big reveal. After some digging, our detective finds out that Lufthansa had recently bought a piece of that same subsidiary, HLLC, and the price they paid implied the whole thing was worth around $130 million. So when we adjust Hudson General's stake to reflect that real-world price, its value explodes from $22 million to over $96 million. Even if we write off that Hawaiian land venture just to be safe, the company's total value more than doubles to $137 million. The treasure was hidden in plain sight. And the proof? Well, the proof is in the pudding. This was the final winning bid for the company. After a bidding war broke out, Hudson General was actually bought for $133 million.
That proves our reproduction cost analysis wasn't just some academic exercise, it was an incredibly accurate prediction of the company's real market value. But here's the final twist, the moral of the story. Our analysis was spot on, but what actually forced the market to see that hidden value? A catalyst. In this case, it was the company's own management. They tried to buy the company for themselves on the cheap. That low-ball offer was like a flare in the night, signaling to everyone else that there was a huge bargain here. It kicked off the bidding war that finally got shareholders the true value they deserved. So let's wrap this all up. Let's bring our investigation to a close and talk about the crucial lesson here. What's the final clue you need to take away from all this? It really comes down to adopting the detective's mindset. You have to remember, book value is just where the investigation starts. It's never the end. A healthy company's true worth is almost always what it would cost to reproduce it. You have to actively hunt for those hidden assets in the R&D, in the customer loyalty, in those special licenses. And here's a good tip. The more complicated a company looks on the surface, the more dark corners it has for value to hide. So I'll leave you with this. The next time you look at a company's annual report, are you just going to see the price on the tag, the number printed on the page, or are you going to see the start of an investigation and look for the treasure that might be hidden just beneath the surface? All right, let's jump right in. You see a company raking in cash year after year, and it's easy to think, wow, they've got it made. They're unstoppable. But here's the thing. In business, there's this constant, powerful force, kind of like gravity, always trying to pull those profits back down to earth. It's called competition. So what's the real shield? What actually protects a company? Is it just having a famous brand? A killer product? Well, as you're about to find out, the real story is way more interesting than that.
So here's the game plan. We're going to start with that gravity of competition, then talk about why even the strongest brands sometimes aren't enough. From there, we'll figure out what a real moat looks like, where it comes from, and what the ultimate competitive weapon is. And we'll wrap it all up with a playbook that value investors can use. Let's do it.
Okay, first up, the gravity of competition. To really get a feel for this, let's imagine a company. We'll call it Top Toaster. And these guys are crushing it. They make the best toaster on the market, everybody wants one, and they are just printing money. From the outside, it looks like nothing can go wrong. So let's put some numbers on this. Top Toaster is consistently making $10 million in profit every single year. Now, for an investor who wants, say, a 10% return, that stream of profits makes the business worth a cool $100 million. That's its earnings power value. It's basically what the company's profit machine is worth right now. And yeah, that is a very attractive number. But, and this is a huge but, here's where the story takes a turn. Some smart entrepreneur is watching this from the sidelines. They do their homework and figure out that they can build a competing toaster factory, get the designs, the machinery, the whole shebang, for only $40 million. Think about that for a second. You can spend $40 million to create a business that's spitting out profits worth $100 million. That's an insane opportunity. It's like a neon sign flashing free money. So what do you think happens next? Exactly. An opportunity that good is like blood in the water for sharks. It's not going to stay a secret. That huge gap between the investment and the prize, that's basically a starting pistol for the competition. It's just human nature. It's capitalism 101. Someone is absolutely going to jump in. And this is where that gravity I mentioned kicks in. The first competitor jumps in. Suddenly, Top Toaster has to lower its prices, and bam, their profits fall to $8 million. But wait, it's still a really profitable business. So what happens? Another competitor sees that, and they jump in too. Now profits fall to $6 million. This process just keeps repeating, this wave of competition washing over the market until Top Toaster's profits are ground down to just $4 million. At that point, the return on building a new factory is just, okay, it's not amazing anymore. The big, juicy opportunity is gone. The market's found its new, brutal normal.
So how do you stop that from happening? The textbook answer is always build a strong brand, right? Make your product special. But is that really the silver bullet everyone thinks it is? Let's put that idea to the test. And we're not going to use a small example. Let's look at one of the most iconic, powerful brands in the entire world.
Okay, so think about Mercedes-Benz. The name alone just screams luxury, quality, prestige. People will happily pay a premium for that iconic star on the hood. That's the image, right? But now let's look at the reality of the business, at least back in the mid-90s. You'd expect them to be making incredible profits, but the numbers told a totally different story. Their return on assets was, well, it was barely covering the cost of the capital they were using. Why? Because for every person who wanted a Mercedes, there was a BMW, a Lexus, an Audi, all fighting tooth and nail for that exact same customer. The competition was just ferocious.
And this quote just hits the nail on the head. A strong brand and a profitable franchise are not the same thing. Just because people love your product doesn't mean you're safe. As long as another company can come along, spend a ton on marketing, build a quality product, and create their own premium brand, they're going to eat your lunch. Your brand is an asset, sure, but in many cases, its value is really just the cost of what you spent to build it.
Okay, so if a brand isn't the impenetrable fortress we thought it was, then what is? What's the real moat? The answer lies in something called a franchise, and it's built on barriers to entry, real structural walls that competitors just can't climb over. Here's the definition, and this is absolutely central to everything. A real franchise isn't just a successful company. It's a business that's protected by some kind of structural advantage that makes it nearly impossible for a newcomer to compete on a level playing field. We're not talking about having a slightly better ad campaign or a smart CEO for a few years. We're talking about the game itself being rigged in your favor. So when you hear franchise, barriers to entry, or competitive advantage, they're all just different words for this exact same powerful idea. All right, so where do these powerful advantages actually come from? The good news is they're not some magical, mysterious force. They actually fall into a few distinct categories. Think of this next part as your toolkit for spotting these truly exceptional businesses. When you boil it all down, there are really only 3 sources of a durable competitive advantage. First, you've got government protection. Think patents or exclusive licenses, where the law literally says no one else can do this. Second, there are sustainable cost advantages, when a company is just structurally set up to produce something cheaper than anyone else. And third, my personal favorite, is customer captivity. This is when customers are, for one reason or another, kind of stuck with you. Now let's double-click on this customer captivity idea because it is incredibly powerful. It really breaks down into 3 flavors. First, there's simple habit. Think Coca-Cola. You don't do a cost-benefit analysis at the vending machine, you just buy a Coke. It's automatic. Second, you've got high search costs. A great example is home insurance. Could you find a better deal? Maybe, but the process of shopping around is such a massive pain, and the risk of picking the wrong one is so high that most of us just renew every year without thinking. And finally, the big one, high switching costs. Imagine you're a giant corporation running on Microsoft software. The idea of ripping all that out and replacing it, it's a nightmare. It's expensive, disruptive, and super risky. You're not just a customer, you're a captive audience. Okay, now for the grand finale, the ultimate competitive weapon. This one is probably the most powerful and long-lasting advantage of them all. It's not just a cost thing or a customer thing. It's a beautiful, powerful combination of both.
It all starts with something you've probably heard of, economies of scale. The idea is really simple. If you have to spend a ton of money upfront to create something, what we call high fixed costs, then the more you sell, the cheaper each one gets on average. Software is the perfect example. It might cost Microsoft $1 billion to create the first copy of Windows, but the cost of making the millionth copy, pretty much zero.
But, and this is the critical piece that everyone misses, scale by itself is not enough, not even close. It only becomes a real weapon when you combine it with a dominant market share. I mean, think about it. If you have 10 companies that each have 10% of the market, they all have roughly the same scale, right? So none of them have a cost advantage over the others. The whole advantage just vanishes. Look at Intel. For decades, they've owned something like 90% of the market for computer chips. Because they sell so many more chips than their competitors like AMD, they bring in way more cash. And what do they do with that cash? They pour billions more into research and development. This creates this incredible self-reinforcing loop. More sales means more R&D money, which means better chips, which means more sales. It's a cycle that is almost impossible for a smaller competitor to break.
So, putting it all together, we now know what a real franchise looks like and where those advantages come from. This brings us to the most important part, the so what for any investor or manager. The key insight is this: your strategy has to match your advantage. There is no one-size-fits-all playbook.
This table really lays it out perfectly. If your advantage is that you have captive customers, think Microsoft, your strategic priority is to slowly and carefully raise prices. Exploit that pricing power because your customers can't easily leave. But if your advantage is economies of scale, like Intel or Walmart, Raising prices is the dumbest thing you could possibly do. Your only job is to protect your market share, even if it means keeping prices low. The moment you get greedy and raise prices, you're just inviting competitors to come in, steal your volume, and destroy the very foundation of your advantage. Getting this distinction wrong is literally how giant successful companies die. And that's really the bottom line. Being able to see the difference between a company with a hot brand and one with a true, durable franchise, that's the difference between gambling and investing. This framework is the key. It's how you find the businesses that aren't just one-hit wonders, but the ones that can keep winning and compounding your wealth for years and years to come. So I'll leave you with this one simple question to ask yourself from now on. When you look at any company, are you just seeing its brand, or are you seeing its fortress? Are you looking at a fancy paint job that any competitor can copy with enough marketing dollars? Or are you looking at a castle with thick stone walls and a deep, wide moat that nobody can cross? Answering that question, well, that's everything. You know this can. I mean, you've seen it 1,000 times, right? In your garage, under the kitchen sink. You probably have one right now. It's simple, it works. But what if I told you that this little blue and yellow can is actually a financial fortress? One of the most perfectly designed business models you'll ever see. So today, we're going to peel back the label and see what makes this thing tick. I mean, just think about this for a second. 4 out of 5 homes in America have a can of WD-40. That's an insane level of market penetration. But the real secret here, the magic, it's not the lubricant itself. Nope. The source of its incredible financial strength is something completely invisible. And when I say strength, I mean it. For years, this company has been generating a return on its own capital of around 40%. Now, to put that in simple terms, for every single dollar the company has invested in itself, it gets 40 cents back in profit. Every single year. That is an absolutely astronomical number. It's the kind of profitability that should have competitors breaking down the doors to get a piece of the action. Which brings us to the central mystery of this whole thing, the formula for WD-40. It's not a secret. Anybody could copy it tomorrow. They don't have any patents protecting it. So how on earth does a company with basically no secrets maintain that kind of profitability year after year after year? Well, that's what we're here to figure out. The company itself calls WD-40 a fortress. And you know what? That is the perfect way to describe it. From the outside, it just looks like a can, but it's engineered to be completely impenetrable. So let's start taking a look at the pieces of this puzzle. So just check out this setup. For most of its life, we're talking a one-product company. And get this, they don't even make this stuff themselves. It's all outsourced. The formula, like we said, is an open book, and there are no patents. I mean, by any normal business logic, this thing should be an easy target, right? It should be totally vulnerable. And yet, it just keeps printing money. Okay, so to really understand this fortress, we first need to measure its true power. We're going to completely ignore the day-to-day noise of the stock market and figure out what this company's real sustainable earning power is. Think of it like we're popping the hood to see the true horsepower of the engine. And the tool we're going to use for that is called earnings power value, or EPV. It's a really brilliant and simple concept. We're going to ask, what is this business worth based only on the reliable profits it's making right now? We're going to throw all the hype about future growth right out the window. This gives us the purest, most honest look at the health of the business as it stands today. So how do we do it? Well, it's kind of like figuring out your real take-home pay. First, we start with their operating income. That's the profit from the core business, before any fancy accounting. Second, we have to smooth out all those so-called one-time charges. You know the ones, the expenses that companies swear will never ever happen again, until next year. And finally, and this is really important, we adjust for what it actually costs to maintain their equipment, not the made-up number accountants call depreciation. So after you run all the numbers for WD-40 back in 1998, you land on this figure, $22.1 million. That's it. That was the real, sustainable, honest-to-goodness cash profit the business generated that year. This is the annual cash engine we're trying to put a price tag on. So what's a machine that prints $22.1 million a year actually worth? Well, it depends on the return an investor wants. We call that the cost of capital. As you can see here, if you only need a super safe 6% return, you'd pay $365 million for it. If you're more of a risk taker and want a 12% return, you'd only pay $183 million. For a steady Eddie company like this, a reasonable middle ground is about 8%. And that gives us our number, an earnings power value of $274 million.
Go ahead and lock that number in your head. It's important.
All right, so the business's ability to make money is worth 274 million bucks. But this is where the mystery really deepens. Because when you look at the company's books, all the physical stuff it owns, the factories, the trucks, the equipment, it's worth just a tiny fraction of that.
So you have to ask yourself, where is all that extra value hiding? If it's not in the factories, which it isn't since they outsource, and it's not in some massive real estate empire, where is it? The value has to be coming from somewhere that you can't see on a balance sheet.
And this chart just lays it out in stark relief. Look at that bar on the left. The company's physical assets, according to the accountants, are worth maybe $70 million. But, and this is the whole game right here, if you wanted to start a company from scratch and actually compete with WD-40, our analysis shows you need to spend closer to $180 million. So what explains that massive $100 million gap?
Well, the answer is, it comes from these powerful, invisible assets that don't show up in the accounting. All those decades of advertising, that's not an expense that just disappears. It's an investment that builds trust, which we call brand equity. All the work to get the can into every hardware store in the country, that's a distribution network. And when you put those together, you get the most valuable asset of all, the simple, ingrained habit of millions of people.
And when you add all of these invisible assets up, they create something that investors get really excited about. A deep, wide, nearly unbreachable competitive moat. This is the real secret to the fortress.
I mean, this quote from the analysis just says it all, doesn't it? Think about your own life. You use it, it works. Your dad probably used it, maybe your granddad too. It's just what you do. So a competitor isn't just trying to sell you a different product. They have to try and break a lifelong habit. And that is an incredibly tall order.
Let's just play this out. You're standing in the aisle at the hardware store. There's the familiar can of WD-40 for $3, and right next to it is Squeak No More for 10% less. You save, what, 30 cents? Is it worth 30 cents to risk that the new stuff might not work when you've got a rusty bolt that absolutely has to come loose? For almost everybody, the answer is a hard no. The mental cost of switching is massive, even if the financial savings are tiny.
And you know what? The hard numbers back this up completely. The financial models show that even if a competitor could magically come in and steal a quarter of the market, they would still probably lose money. Why? Because they'd have to spend a fortune on marketing and sell at a discount, while WD-40, with its huge scale, could just drop its price to match and still be profitable. Any rational person looks at that math and just walks away. It's a losing game.
So here they are, the four walls of the fortress, all laid out. You've got that powerful, ingrained customer loyalty. You've got high switching costs because the price is so low. You have economies of scale, meaning WD-40 can make it cheaper than anyone else. And then there's this last brilliant wall. The market is actually too small to attract the really big fish. A giant company could try to compete, but the fight would be so brutal and the prize so small, it's just not worth their time.
So now that we've completely deconstructed the fortress and we understand its defenses, let's circle back to the main event. Let's translate all of that strategic strength into a final valuation. What is this company really worth?
Well, a great moat isn't just for defense. It lets you play offense, too. Because customers are so incredibly loyal and the price is so low, WD-40 has what's called pricing power. I mean, think about it. If they raise the price by 30 or 40 cents a can tomorrow, would you even notice? Would you stop buying it? No way. But for the company, that tiny little price hike flows directly to the bottom line and would boost their net income by a staggering 40%. That's power.
You know, we can even come at this from a totally different angle, just to check our work. If we use a different tool, one that values the company based on its super steady dividend payments, we get a value of around $25.60 per share. Now, what's really important here is that this number is actually higher than our original no-growth valuation. It tells us that our first estimate was conservative, and that any growth the company manages is pretty much just free icing on an already very profitable cake.
So, when you pull the camera back, what's the big lesson here? What's the takeaway from this deep dive into a simple can of lubricant? Well, it's about a lot more than just one company. It's really about a different way of seeing value in the world.
The real lesson of WD-40 is that sometimes the most incredible, durable businesses are the most boring ones, the ones that are so familiar, so mundane that we just completely overlook their power. So the question isn't just about what WD-40 is worth. The real question is, what other financial fortresses, built on simple habit and loyalty, are hiding all around us, right in plain sight? Welcome to the Explainer. Today, we're going to tackle a classic Wall Street puzzle. How do you actually put a price on growth? And to figure it out, we're not just going to talk theory. Nope. We're going to jump in a time machine and dissect one of the undisputed giants of tech, Intel. You know, this quote from our source material it gets right to the heart of the problem, doesn't it? It's so easy to get swept up in the excitement of a fast-growing company. But the real question is, how many of them are actually creating real cash value for their investors along the way? That's the tricky part, and that's exactly what we're going to dig into.
You know how Wall Street is, right? It just loves to put everything into these neat little boxes. And we're told you gotta pick a side. Are you on team value? You know, the bargain hunter always focused on hard assets and that all-important margin of safety? Or are you on team growth? The visionary, the one betting on a big story about the future, even if it means you gotta pay a premium today? And right there, that's the paradox we're here to solve. I mean, think about it. How could a really disciplined value investor, someone who absolutely demands a margin of safety, ever bring themselves to buy a high-flying tech stock like Intel, a company that, let's be honest, almost always looked expensive on the surface? Well, the answer, as we're about to see, is buried deep inside the numbers.
Okay, let's get right into it. Here's the game plan for how we're going to break this all down. We'll kick things off with the paradox itself, then we'll build up our valuation piece by piece, starting with the assets, then the core earnings engine, and only then will we talk about the value of growth. This is going to lead us to the exact moments an investor could have made a move, and a lesson that, believe me, is just as relevant today as it was back then.
So how do we bridge this huge gap between value and growth? Well, it all starts with two rules. Let's call them non-negotiable rules. These are like the mental gates a true value investor has to walk through before they'll even think about paying a single dime for a company's future growth.
Okay, rule number 1, the growth has to be happening inside a strong business franchise. We're talking about a company with a deep, sustainable, competitive moat. Because let me tell you, not all growth is good growth. Rule number 2, because the future is always uncertain, you have to demand to get that growth for free. Yeah, for free. You pay a fair price for the business as it stands today, and all that future potential, that becomes your margin of safety. If you can get those two things right, well, that changes the whole game.
All right, now let's put this whole framework to the test. We're going to start with the first, most tangible source of value, a company's assets. Let's ask the big question. What would it actually cost to rebuild Intel from scratch?
So, if you just look at a standard metric like the market-to-book ratio, Intel almost always looked, well, pretty darn expensive. I mean, look at this chart. The market consistently valued the company at 2, 3, sometimes even 4 times the stated value of the assets on its balance sheet. For a traditional value investor, that's an immediate red flag. They'd probably just close the book and walk away. But, and this is the first crucial insight, the balance sheet just doesn't tell the whole story. Not even close. We have to start thinking like a competitor. What would it really cost in real dollars and real time to build Intel's entire business from the ground up today? That's this concept of reproduction cost.
And what that means is we have to account for these massive investments that, accounting rules just treat as expenses, but in reality, they're long-term assets. Just think about it for a second. A competitor would have to spend years and billions of dollars just to replicate Intel's accumulated R&D knowledge. Not to mention the fortune they'd have to spend to build the kind of deep sales and marketing relationships Intel had with its customers. These are real, incredibly valuable assets, even if they're not on the books.
And when we actually do that, when we add those assets back in, just look what happens. See the dotted line? That's the standard ratio we saw before. It's way up there. But the solid line, that shows the adjusted ratio after we've capitalized all that hidden R&D and marketing. The entire picture just flips. All of a sudden, the valuation looks a whole lot more reasonable, doesn't it? You know, this adjusted view reveals something absolutely incredible. It shows 3 distinct moments back in the 1980s when the market was literally offering you the chance to buy the entire Intel corporation for less than what it would cost to simply build it. These weren't just dips, they were true, bona fide buying opportunities. All of a sudden, that expensive growth stock, well, it wasn't so expensive after all. Okay, let's move on to the second source of value and see how this all builds. We've figured out what the assets are worth. Now let's nail down what the company's core profitability, its earnings engine, is worth, completely separate from any future growth. And we do this with a concept called earnings power value, or EPV for short. It's a really powerful thought experiment. Just imagine,
The company stopped growing. Today, flatlined. What would its current, sustainable stream of profits be worth if it just kept chugging along forever? This calculation completely isolates the value of the business as it exists right now, in the present.
And this chart, right here, shows the magic moment. The dashed line, that's the asset value we just calculated. The solid line is its earnings power value. Now watch what happens right around 1988. See that? They cross. This is huge. It means Intel's existing business, with zero future growth factored in, was suddenly worth more than all of its tangible and intangible assets combined.
Now, this isn't just some random line on a graph. It's the mathematical proof of what we call a franchise. It means the company has built such a powerful competitive advantage through its tech, its scale, its brand, that its assets are now generating profits far, far beyond what any old generic competitor could ever hope to earn. Intel had built a fortress, and the numbers were finally showing it.
So let's recap. We have the asset value. We have the value of the current earnings engine. Only now, with that solid foundation in place, are we finally allowed to ask the last question: what's the growth actually worth? And this brings us to what might be the single most important principle of this whole explainer. Growth, by itself, is not automatically valuable. It only creates real wealth for shareholders if the return the company earns on new investments is higher than the cost of funding them. Think about it. If you spend $1 to grow and you only get 90 cents of value back, you're actually destroying wealth, no matter how fast your revenues are climbing.
This matrix from the source material shows just how powerful this concept really is. When a company earns really high returns on its capital, and it has opportunities to reinvest and grow at those same high rates, well, the value creation just becomes explosive. The total value of the company can become double, even triple its no-growth value. That combination, right there, is the holy grail of investing. And when the authors of our source material ran the numbers for Intel around 1990, that's exactly what they found. Intel's return on capital was so high, and its growth prospects inside that PC fortress were so strong, that the value of its future growth was roughly equal to the entire value of its existing business. Think about that. It meant the company's total value was about twice its no-growth EPV. An investor could pay the full price for the existing business and get all of that incredible future growth completely for free. A 50% margin of safety on a premier growth company. Okay, let's bring it all home now. We've seen the 3 distinct opportunities to buy Intel at its reproduction cost. We've watched its franchise emerge in the numbers, and we've seen just how unbelievably valuable its growth was. So, what did all this mean in the real world? Well, the payoff for doing all this detailed work was just staggering. This table shows the returns you would have gotten from buying during those windows of opportunity. An investment in late 1986 or 1988, right when the franchise was proven and the growth was essentially free, generated returns that absolutely crushed the market over the next 5 years. This is exactly what happens when discipline meets a great opportunity.
So, after all that analysis, after digging through Intel's entire history, what's the big takeaway? What's the timeless lesson here for how we should think about growth stocks? It's this clear, repeatable 3-step framework. Step 1, you ignore the simple book value and you calculate the true reproduction cost of the assets, including all those hidden investments. Step 2, you calculate the company's no-growth earnings power value. If that EPV is higher than the asset value, congratulations, you've found a franchise. And finally, step 3, you patiently wait. You wait for a moment when the market is pessimistic enough to sell you the shares at a price that reflects the value of the franchise today, which effectively gives you all of that valuable future growth for free. And that leaves us with one final, and I think pretty provocative question. This isn't just a history lesson, right? This framework is absolutely timeless. The market still gets overly pessimistic about great companies all the time. So the real question for us today is this. If we use this same disciplined approach, what great company's valuable growth is the market giving away for free right now?
All right, today we're going to tackle one of the biggest, most misunderstood words in all of finance, risk. And we're not just going to define it, we are going to completely dismantle the conventional wisdom around it. We'll be using the playbook of some of the world's greatest value investors to explore a totally different and, I'd argue, a much smarter way to think about risk in your own portfolio.
So, let me ask you something right off the bat. How do you actually measure investment risk? I mean, when you think about a risky stock, what really pops into your head? Is it just a bad gut feeling, a stock chart that's taken a nosedive? Well, for about the last 50 years, the entire academic and financial world has been pushing one very specific, very mathematical answer.
And there it is, the textbook definition, straight out of modern portfolio theory. It says risk is just volatility. You've probably heard of the metric beta. That's what this is all about. All it means is the more your portfolio jumps up and down, the riskier it is. Simple as that. Now, this one idea is the foundation for how trillions of dollars are managed, but what if it's just plain wrong?
Okay, so here's our game plan. First, we're going to pick apart that conventional wisdom. Then, we'll get into what real risk actually is. From there, we'll open up the Value Investor's Toolkit, look at some much smarter ways to diversify, talk about the incredible power of doing nothing, and wrap it all up with a really critical question every single investor needs to ask themselves.
All right, so first up, let's talk about the establishment's view. This is the theory that gets taught in every business school and pretty much hard-coded into every financial model on Wall Street.
So the whole premise is basically this. The unique risks of any one company, a bad CEO, a product flop, you can pretty much cancel all that out just by owning hundreds of different stocks. Once you do that, the only risk you're left with is the big one, the entire market going up or down. And the theory says that's the only risk you get paid to take. But here's the catch. This whole worldview depends on markets being perfectly efficient and prices always being right. And, well, value investors, they couldn't disagree more.
And that brings us right to the heart of it. If the daily zigzag of stock prices isn't the real danger, then what is? This is where the whole value investing philosophy just completely flips the script on traditional finance.
And this quote from Warren Buffett just nails it. He's talking about a real investment he made in the Washington Post. He figured the whole company was worth at least $400 million, and he got to buy a huge chunk of it for just $80 million. But then the stock price got cut in half. So according to the textbooks, his investment just got twice as risky. But Buffett just lays out the logic. How on earth is it riskier to get the chance to buy a $400 million business for $40 million? It just shows how absurd that old definition is, right?
So here is the key takeaway. For a true value investor, risk has absolutely nothing to do with how much a stock price bounces around day to day. Real risk is much simpler and much scarier. It's the chance that you will permanently lose your money. It's the danger that the business you actually own suffers some kind of irreversible damage. You see, a market panic that makes prices crash, that's an opportunity. A great company that slowly turns into a bad one, that's the real catastrophe.
Let's just put these two worldviews side by side so it's crystal clear. On one side, you have the market, completely obsessed with volatility, those temporary and frankly often irrational price swings. On the other side, you've got the value investor, who is laser-focused on just one thing, avoiding a permanent loss of capital because the underlying business went bad. They are playing two completely, and I mean completely, different games.
Okay, so if you're going to define risk in this whole new way, you're obviously going to need a new set of tools to handle it. So let's look at how value investors actually turn this philosophy into a practical, real-world strategy.
It really comes down to this three-part toolkit. Number one, you stay strictly inside your circle of competence. Put simply, you only invest in businesses you can genuinely understand. If you can't explain it, you don't buy it. Number two, and this is the absolute bedrock of the whole thing, you demand a margin of safety. You figure out what a business is actually worth, and then you insist on buying it for way, way less. Think paying 60 cents for something you know is worth $1. And finally, instead of diversifying like crazy, you build a concentrated portfolio. You put your money behind your absolute best ideas.
And yeah, that idea of concentration, it can sound pretty radical to a lot of people. A properly built portfolio, based on that margin of safety principle, might only have 10 to 15 stocks, but the logic is powerful. Owning a handful of businesses you understand deeply, that you bought at a huge discount, well, that's fundamentally less risky than owning 100 companies you know next to nothing about. It's the knowledge that reduces the risk, not just the number of stocks you own.
Now, all this talk about concentration, it doesn't mean diversification is a dirty word or anything. Not at all. Value investors just think about it in a much more sophisticated way than just buying a long list of different companies. See, the real goal of diversification isn't just to own more things. It's to own things that zig when other things zag. It's the classic example, right? You own an umbrella factory and you own a suntan lotion company. One business is going to do great when it's raining, the other's going to do great when it's sunny. Their success isn't tied together. The trick is finding investments in the real world that actually have that same quality.
And this is where things get really interesting, and where some of the most creative investors play. They look for what are called event-driven investments. Just think about it for a second. Does a corporate merger getting approved by regulators have anything to do with what the S&P 500 did today? Nope. Does a company successfully coming out of bankruptcy depend on GDP growth? Not really. The payoff for these kinds of investments is tied to a specific event, not the daily mood swings of the overall market. Now we get to what might be the single hardest part of this entire philosophy. Seriously, what do you do when you've done all the work, you've looked everywhere, and you just can't find a single thing to buy that meets your strict rules for value and safety?
And Buffett, of course, has the perfect analogy for this: baseball. He says, in investing, unlike in baseball, there are no called strikes. You can stand there at the plate and watch thousands of pitches go by, overvalued tech stocks, crazy fads, businesses you don't understand, and guess what? You don't have to swing at any of them. You can just wait and wait and wait for that one perfect pitch right in your sweet spot.
So the crucial point here, and it sounds crazy, is that for a value purist, the correct action is often no action at all. Holding cash isn't a sign of being lazy or scared. It's an act of discipline. A growing pile of cash isn't a failure. It's a powerful signal, kind of like a canary in a coal mine, telling you that good deals are getting really hard to find, and maybe the whole market is getting a bit frothy.
But, let's inject a dose of reality here. For the true purist, holding cash is the only move. But imagine you're a professional fund manager. Your clients and your boss are judging you every single quarter. Sitting on a mountain of cash while the market is screaming higher, that's what they call career risk. It's a great way to get yourself fired. So the pragmatist often makes a compromise. They'll just buy a low-cost S&P 500 index fund. That way, they at least keep up with the market while they wait for a truly great idea to come along.
Okay, let's pull all these threads together now. We've torn down the old definition of risk, we've looked at a whole new toolkit to manage it, and we've talked about the insane discipline it takes. So, what's the ultimate lesson from this contrarian playbook? It really all boils down to this one simple idea. Value investing is not about predicting the stock market. It's not about forecasting the economy. It is the disciplined craft of analyzing a business. It's about figuring out what a company is really worth and then having the patience to buy it only when it goes on a deep, deep sale. All the hard work, the real work that cuts your risk, that's all done before you even think about hitting buy.
Now I'm going to leave you with one last kind of chilling piece of wisdom from Buffett. He says the stock market is just one big poker game. Every day, the professionals sit down to play against the amateurs. And over time, the money just flows from the amateurs to the pros. So if you're out there investing without a clear philosophy, without your own definition of risk, without a real process, you have to ask yourself, who are the pros at the table counting on to make all the mistakes?
So that's the final question I want to leave you with. When you put your own money on the line, are you actually playing your game, operating inside your circle of competence with a margin of safety in a game you know you can win? Or are you just getting sucked into playing the market's game, chasing hot stocks and reacting to scary headlines? It's probably the most important question any of us can ever ask as an investor.
Warren Buffett, the man's a legend, right? Probably the most successful investor in history. But you know what's really amazing? It's not just his stock picks. It's how he can take these super complex ideas and just make them simple. So I was thinking, what if we could actually go through his own words, pull out decades of his wisdom, and build the ultimate investment playbook? Well, guess what? That's exactly what we're going to do right now. And this quote, this really gets right to the heart of everything. See, for Buffett, there's literally no difference between buying one single share of a company and buying the whole darn thing. It all comes down to this one really powerful shift in your mindset. You're not buying a ticker symbol that just bounces around on a screen. No, you are buying a piece of a real, actual business. All right, so to really get inside his head, we're going to break this down into a 5-part journey. First, we'll cover the core Buffett mindset. Then we'll dig into how he finds what he calls wonderful companies. After that, we'll tackle his, kind of surprising take on value versus growth. Then we're going to totally redefine what risk actually means to him. And to wrap it all up, we'll look at the big lessons he learned from his own very expensive mistakes.
Okay, let's dive in. First step, the Buffett mindset. Look, before you can even begin to invest like him, you've got to learn to think like him. And that means making a huge shift from thinking like a stock trader to thinking like a business owner.
So, in what he calls his owner's manual, it's a great metaphor. He lays out a few ground rules. Rule number 1, you have to see the company's managers as your partners. Number 2, they've got to eat their own cooking. What does that mean? It means their own money is on the line, right alongside yours. And third, and this is so important, the goal isn't just to get bigger. It's about making every single share you own more and more valuable over time. And that leads us right to the absolute cornerstone of his entire philosophy, intrinsic value. It sounds complicated, but it's really just a simple question. If I bought this whole business today, how much cash could I pull out of it for the rest of its life? Now here's the key, the most critical thing to get. This is not some precise number you can calculate down to the penny. It's always just an estimate.
And that right there is the ultimate goal. See, it's not about sales growth or market share or how many people the company hires. It is a laser focus on one thing and one thing only, making each share you own worth more. In Buffett's world, pretty much everything else is just noise.
Okay, so you've got the owner's mindset down. Now what? How do you actually go out and find these amazing businesses? Well, Buffett has this great analogy. He says it's like hunting for rare and fast-moving elephants. They're tough to find, for sure, but bagging one of them, well, that can make your entire career.
And for decades, he's used this ridiculously simple 4-point checklist. Number 1, do I actually understand this business? 2, does it have good long-term prospects? 3, are the people running it honest and good at their jobs? And 4, the last piece, is the price attractive? Think about that for a second. 3 of those 4 questions have absolutely nothing to do with stock charts or financial ratios. It's all about the quality of the business.
This quote right here, this is huge. It marks a massive change in how he thought about things, and he gives all the credit for it to his partner, Charlie Munger. See, when he was starting out, Buffett was what he called a cigar butt investor. He'd buy these awful companies just because they were super cheap. But he learned the hard way that a wonderful company, even if you pay a fair price for it, is just a way better investment in the long run. So, what is a wonderful business anyway? What's he talking about? Well, it's not just a company that's profitable right now. It's a company that has this incredible internal engine. It can take the money it makes, reinvest it back into the business, and earn even higher returns on that new capital. It's like a magic machine that turns $1 of profit into more than $1 of real value. That, my friends, is the secret sauce of compounding.
All right, that brings us to our third section, and we're going to tackle one of the biggest and frankly silliest debates on Wall Street, value versus growth. Buffett's take on this just completely changes the game. In fact, he thinks the term value investing doesn't even make sense.
You know the drill, right? Wall Street loves to put you in a box. You're either a value investor buying cheap, boring stuff, or you're a growth investor chasing expensive, flashy companies. Well, Warren Buffett says that's just nonsense. It's fuzzy thinking. For him, growth is just part of the value equation. They're not two different things. In his own words, they're joined at the hip. And he's got the perfect and really painful example, the airline industry. I mean, think about it. For decades, that industry grew like crazy. Always buying new planes, needing tons of money. But all that growth, it was a total disaster for the owners, the shareholders. So here's the takeaway, the really crucial point. Growth is only good for you, the investor, if the company can earn more on that invested money than the money itself costs. It's that simple. And this quote just nails it. He's basically asking a rhetorical question, right? How can you even call it investing if you're not trying to get something that's worth more than what you paid? If you're knowingly paying more for something than it's worth, that's not investing. That's just gambling. It's speculation. So for him, all real investing is value investing, period. Okay, on to lesson number 4. And this one is about risk. Now, the folks in academia, they have one definition of risk. But Buffett, he has a completely different view, one that's a whole lot more useful in the real world. He's going to tell you that all that up and down market movement, that's not risk. That's opportunity knocking. So let's just put it out there. What really is investment risk? Is it just that your stock might drop tomorrow? Or is it something, I don't know, deeper, something more permanent? And you can't get 2 more different answers. The academics will tell you risk is volatility. They even have a fancy Greek letter for it, beta. So in their world, if a fantastic company's stock price drops by 20%, they say it just got riskier. Buffett thinks this is just completely nuts. For him, risk is one thing, the possibility that you will permanently lose your money. That's it. And from that point of view, when a great business gets cheaper, the risk goes down, not up. And to really hammer this home, he loves to use the story from his mentor, Ben Graham. It's the story of Mr. Market.
So imagine you co-own a business with this guy, Mr. Market, and, well, he's a manic depressive. Every single day, he shows up and names a price. He'll either buy you out or sell you his half. Some days he's euphoric and he'll offer you a crazy high price. Other days he's in a total panic and he'll offer to sell you his shares for next to nothing. The beautiful part is you don't have to do a thing. You can just ignore him until he has one of his meltdowns and offers you a bargain. His mood swings are your greatest advantage.
So, if risk isn't beta, then what is it? Well, Buffett says it's a bunch of stuff that's, and I love this phrase, unbearably fuzzy. You can't just plug these into a spreadsheet. It's about how sure you are about the business's future, how sure you are about the people running the show, how sure you are that they'll treat you right, and of course, the price you pay. It's not a math formula, it's business judgment. It's an art.
All right, we've made it to our final section. And honestly, this might be the most valuable one of all. We all know about Buffett's home runs, but what's amazing is how open he is about his strikeouts. The lessons he learned from his biggest blunders, that's where the real gold is in his playbook.
So his first big mistake was a strategy he called the cigar butt approach. Picture this. You're walking down the street and you see a soggy, old cigar butt lying there. But it looks like it has one good puff left in it. So you pick it up, take that one free puff, and toss it. That's what he was doing with businesses, buying terrible companies for pennies, hoping for one last puff of profit. But what he learned was that with a bad business, there's never just one problem. You find one cockroach, you can bet the whole kitchen is infested.
And this quote just perfectly sums up the lesson he learned. Time, he says, is the friend of a wonderful business, but it's the enemy of a mediocre one. It's so simple, right? A great business just gets better and better with time. A lousy one just gets worse. And ironically, the Berkshire Hathaway textile mill, the company that's now his famous brand, was one of those original cigar butts that taught him this painful lesson.
And there were other hard-won lessons too. Like, he realized you can have the best manager in the world, but if they're in a leaky boat, a business with bad economics, they're still gonna sink. He also learned about something he calls the institutional imperative. This is this weird force that makes companies just copy each other, even when it makes zero sense. And finally, he learned to just stick to the easy stuff. Focus on the 1-foot hurdles you can step over, not the 7-foot hurdles you have to be a superhero to clear.
So let's wrap this all up with this one core idea. Buffett says that being a great investor isn't about having a 200 IQ. It's about having emotional control. It's about being really, really honest with yourself about what you understand and maybe more importantly, what you don't. So the final question this whole playbook leaves you with is, well, it's for you to answer. How big is your own circle of competence? And more importantly, where does it end? Because knowing that boundary, that's where true wisdom begins. Welcome to The Explainer. Today, we are cracking open the playbook of a Wall Street legend, Mario Gabelli. We're going to dig into his unique strategy for finding incredible value in places that, well, almost everyone else just ignores. Okay, let's just dive right in because we have to start with the big question, the fundamental challenge every single one of us faces as an investor today. Gabelli was wrestling with this years ago. In a world where we're just drowning in information, how on earth do you find an edge? You know, if you think back to the days of Benjamin Graham, you could literally find a hidden gem just by being the guy willing to read through dusty old annual reports. Information was hard to get, and that created opportunity. But now? Shoot, anyone with a brokerage account can screen for low price to book stocks in seconds. The really easy catches are long gone. It means you've got to have a smarter way to fish. So, here's our game plan for unpacking Gabelli's solution. We'll start with that dilemma, then get into his big idea, private market value. We'll look at the 3 pillars that make it work, see it in action with a couple of really cool examples, and then wrap up with the core mindset behind it all. All right, so this brings us to Gabelli's big answer. Faced with a market where all the obvious bargains were gone, he didn't give up. Instead, he pioneered this really powerful concept he calls private market value, or PMV. And honestly, this is the key to his entire approach. And here it is, straight from the man himself. Now that might sound simple, but the magic is in those 2 words, informed industrialist. This is the whole game. We're not talking about what a stock trader on Wall Street thinks. We're talking about what a competitor, a real business operator, would pay to own the whole shebang. So let's just be crystal clear on what this means.
PMV is all about a huge mental shift. You have to stop thinking like you're just buying a piece of paper with a ticker symbol. Instead, you need to start thinking like you are a CEO about to make an acquisition. You're buying the factories, the customers, the brand, everything, with the goal of running it to generate cold, hard cash. And this comparison just nails the difference. You've got Mr. Market, who's, let's face it, kind of a manic depressive, right? Panicking one day, euphoric the next. And then you have the industrialist, who is calm, rational, and focused on one thing. What are these assets actually worth in the real world? When Mr. Market panics and sells, the industrialist sees a sale. And that gap, right there, is where Gabelli found his opportunities.
So that all sounds great in theory, but how do you actually find these opportunities? How do you put on that industrialist hat? Well, PMV isn't just some abstract philosophy. It's a real, disciplined strategy that Gabelli built on 3 solid pillars. Here they are, the 3 pillars. First, you have to understand the value of control, what a buyer will pay extra for to own the whole company. Second, you need the right tools to find the value that the accounting statements are hiding. And third, and this is absolutely critical, you need a catalyst, some kind of event that's going to force everyone else to see the value that you've already uncovered.
Let's drill down on that second pillar, because this is where the real detective work begins. Gabelli's whole idea is looking for gaps in GAAP, that's generally accepted accounting principles. You see, the standard rules of accounting are fine, but they don't always tell the full story. The goal here is to find the real earning power, the real assets that are being distorted or even totally hidden by those rules. And this is how you do it. You start looking past the official income statement and focus on the real world stuff. Forget earnings per share for a second. How many subscribers does this company have? How many hotel rooms? What are those things worth in a private sale? A competitor buying a hotel chain isn't buying last quarter's reported profit. They're buying a collection of buildings that generate cash. They know exactly what each one of those rooms is worth, and that's the number that matters. And that brings us to the final piece of the puzzle, the catalyst. See, it's not enough to just find a cheap company. A cheap company can stay cheap for years. You need a trigger, something that's going to unlock that value. Now, that could be something specific to the company, like a new CEO who wants to sell off divisions. Or it could be something much bigger, an entire industry getting deregulated, for example, which then kicks off a huge wave of mergers and takeovers.
All right, enough theory. Let's see how this actually works in practice. We're going to look at a real-world example, a company called General Housewares. I mean, sounds pretty boring, right? They make kitchen gadgets. This is exactly the kind of company most people would just flip right past.
So imagine you're an investor. You pull up their financials, and this is what you see. It's a total mess, right? Sales are all over the place. Profits are up one year, down the next. It's confusing. It's unpredictable. A typical investor looks at this and just says, nope, too hard, and moves on. But this is exactly where the PMV mindset kicks in. Instead of running away from the mess, Gabelli's approach teaches you to lean into it and ask the most important question. Okay, what is this mess hiding? What's going on underneath the surface that's creating this ugly picture? And wham, here's your answer. When you stop looking at the company as one big blob and you break it down into its actual business units, the parts that make the pots and pans, a totally different story emerges. These operating divisions were actually gold mines. They were generating an incredible 57% return on the assets they used. They were fantastically profitable. So the immediate question is, wait a minute, if the businesses are printing money, where is it all going? And the answer was it was being absolutely devoured by a giant, bloated, inefficient corporate headquarters. Think of it like an anchor. All the profits from the great businesses were being used to pay for corporate jets and a huge staff before a single dollar made it to the bottom line. So Gabelli did the math. An industrialist, another kitchenware company, could buy General Housewares, fire almost the entire corporate office, and just plug the profitable brands into their own, much leaner operation. And by doing that, they could earn a potential return of 45% on their money. That right there, that's the hidden private market value that the stock market couldn't see. Let's look at one more, and this one's even more straightforward. We're heading into the telecom world for a classic case of what you call a sum of the parts discount, where the company as a whole is worth way less than all its individual pieces. So this company, Telephone and Data Systems, or TDS, was basically a holding company. It was like a treasure chest, and inside it owned huge chunks of other publicly traded companies, like US Cellular. The beauty of this was the math was incredibly simple. You could just look up the stock prices of the companies TDS owned and figure out what its holdings were worth on any given day.
And this chart just says it all. It was an absolute gift. The market was selling shares of TDS for $116. But if you simply added up the value of the assets inside the company, they were worth $162 per share. Think about that. The market was literally giving you the chance to buy a dollar's worth of prime telecom assets for less than 75 cents. It was an incredible discount, hiding in plain sight.
Okay, so we've gone through the theory, we've looked at a couple of real-world examples. Let's step back and pull this all together. What is the fundamental mindset, the big picture lesson that we can take away from Mario Gabelli's approach to the market?
It really boils down to these four things. First, you have to force yourself to think like a strategic buyer, not a stock trader. Second, you have to become a detective and look for value that's being hidden either by accounting rules or by a messy corporate structure. Third, you have to find a catalyst, a reason for the value to be unlocked. And finally, you have to believe that true value isn't today's stock price, it's what an informed industrialist would pay for the whole thing.
You know, this playbook isn't just some interesting history lesson. It's a lens, a way of looking at the world that is just as powerful today as it was 30 years ago. And so that leaves us with one final big question. When you look around at today's market with all of its complexity and confusion, what hidden value is everybody else missing right now?
You know, most of us in investing are taught one rule from day one: diversify. Whatever you do, don't put all your eggs in one basket. But what if I told you that one of the most successful investors out there built his entire career by doing the exact opposite? Today, we're going to get into the mind of Glenn Greenberg, a guy who believed the real secret wasn't having a lot of baskets, but finding the one right basket and then watching it like a hawk.
And this is it. This is the quote that pretty much defined Greenberg's entire worldview. It's from Mark Twain, and it flies in the face of almost all conventional financial advice. Instead of spreading your money thin, spreading your attention thin, Twain says to focus, to concentrate. For Glenn Greenberg, this wasn't just some clever line for a presentation. It became the absolute bedrock of his investment strategy.
And this really gets to the heart of what we're talking about today. Greenberg took this completely contrarian idea and turned it into an engine that produced just incredible returns for decades. His whole argument was that, look, diversification is really just a fancy way of admitting you don't know enough. His solution? Simple. Stop diversifying and start knowing your investments so deeply that you just don't need it.
So, how does a person even get to a place like that? A conclusion so radical? Well, I'll tell you. It wasn't in some stuffy finance class. Greenberg's philosophy was literally forged in the fire of a massive, brutal market crash. And it came after a career path that was, well, anything but typical.
I mean, just take a look at his resume. This is not your typical Wall Street prodigy. He studies English Lit, not economics. He becomes a teacher, then a school principal, and only then does he even think about going to business school. But you know what? This different perspective, this outsider's view, turned out to be his greatest strength, especially when he landed a job at JP Morgan, right on the verge of a historic market collapse.
And oh boy, what a lesson it was. In 1973, the market was just euphoric. The buzz on Wall Street was all about these things called the Nifty 50. These were stocks like Avon and Polaroid that supposedly you could buy at any price and just hold them forever. They called them one-decision stocks. Turns out that one decision was very often the wrong one.
And then, bam! Between early 1973 and late 1974, the Dow Jones just cratered, falling by over 40%. The Nifty 50 got absolutely shattered. For young Greenberg, just starting out, this was a formative experience. It stamped on him forever the real risk of losing money and the incredible danger of just getting swept up in market hype.
So what's the big takeaway from all that chaos? He looked around and realized that the so-called experts, even his own colleagues at a huge firm like JP Morgan, they knew next to nothing about the companies they were putting clients' money into. They owned hundreds of stocks. How could you possibly understand them all? Right then and there, Greenberg decided that if he was going to do this, he was going to know his companies inside and out. No more blind faith.
So that experience, that trial by fire, it directly led him to create the philosophy that would make his firm, Chieftain Capital Management, so incredibly successful. He took those painful lessons from the crash and boiled them down into a simple, powerful, and, frankly, radical set of rules.
And here they are. It all comes down to these three pillars. 1. Concentrate. 2. Buy good companies. 3. Buy them cheap. It sounds almost like common sense, doesn't it? Almost too simple. But trust me, the magic is in how he executed each one of these things with brutal discipline.
Let's start with that first pillar, concentration. I mean, look at this. On one side, you have your typical mutual fund, holding 100, maybe 200 stocks, where any single big winner's impact gets watered down. And then you have Chieftain, holding just 8 to 10 names. His rule was ironclad. He would not even think about buying a stock unless he was ready to put at least 5% of his entire fund into it. That forces a level of conviction that's just impossible when you own 100 stocks.
Okay, so if you're only going to own a tiny number of companies, they better be absolutely fantastic. So what did good mean to Greenberg? Well, he thought of it like a fortress with a giant moat around it, a business that was safe from new competitors and wasn't going to get wiped out by some new piece of tech. He wanted businesses that gushed free cash flow and had fat profit margins. And he had a special love for duopolies. Think two big players dominating an industry. They have pricing power but don't attract the same angry attention from the government that a true monopoly does. And finally, because he thought of himself as a business owner, not a stock renter, the management had to be smart and focused on shareholders.
And all of this searching leads to his ultimate prize, what he brilliantly called a 2-inch putt. It's just a fantastic metaphor. You know, you hear all this talk about high-risk, high-reward moonshots. This is the exact opposite. In golf, a 2-inch putt is a sure thing. You can't miss. In investing, for Greenberg, it was an opportunity where you had a super high chance of a great return with a very, very low chance of losing money. It's the perfect combination, a great company at a great price.
All right, so these 2-inch putts sound amazing, but where on earth do you find them? They don't just pop up on a stock screener, that's for sure. They usually show up when there's some kind of panic or confusion in the market, and spotting them requires a really contrarian mind. Let's look at a few real-world examples.
Okay, first up, Freddie Mac. Let's go back to the late 80s. The entire savings and loan industry was basically a dumpster fire, a total crisis. But as part of a bailout, the government forced these troubled S&Ls to sell their shares of Freddie Mac. Because of the panic and the flood of shares hitting the market, Greenberg was able to buy into this fantastic duopoly at a massive discount. The stock doubled in a year. Classic Greenberg. A great business on sale because of a panic somewhere else.
Here's another one I love because it shows him looking right through the popular story of the day. In the mid-90s, the prevailing wisdom was that satellite TV was going to make cable completely obsolete. Cable stocks were getting hammered. But Greenberg, he did the work. He saw that satellite couldn't offer local channels and was a pain to install. But more importantly, he realized the cable companies already owned the wire into everyone's home, the perfect pipeline for future high-margin stuff like broadband internet. He loaded up, and some of those stocks went up 5, even 6 times.
Okay, this next one is my absolute favorite because it's just so clever. It was basically a quirk in the system. When these old thrift banks converted from being privately owned to publicly traded companies, the insiders had every reason to set the initial stock price super low. So you could buy a share for, say, $30, even though the company's actual assets, its book value, was $50. Then the company, suddenly flush with cash, would use that money to buy back its own cheap stock, which made the book value for the remaining shares go up automatically. A few years later, they'd get bought by a bigger bank at a premium. It was a structured, low-risk way to turn $30 into $75, a textbook 2-inch putt.
So you see these incredible investments, and you might think, wow, this guy must have amazing intuition. But it wasn't a gut feeling. Behind every single one of these plays was a ton of hard, grinding, detailed analytical work. This is what separated him from just a gambler. So how did he know something was cheap? What was his tool for the job?
His weapon of choice was the discounted cash flow analysis, or DCF. Now that sounds complicated, but the idea is actually simple. A business is worth all the cash it's going to generate from now until the end of time. DCF is a way to estimate all that future cash and then figure out what it's worth in today's dollars. Now, he knew it wasn't perfect, it's full of assumptions, but its real value, he said, is that it forces you to make every single one of those assumptions crystal clear. It's a powerful defense against wishful thinking. And here's what that looks like in the real world. This is a valuation he did for an energy company. Just look at the table. It basically asks, what kind of annual return do I demand and what price does that allow me to pay? So if he was okay with a 10% return, he could pay up to $77 a share. But if he wanted a 15% return, his max price was $55. At the time he did this, the stock was trading between $32 and $49. That table told him he could buy in with a huge margin of safety and still expect a fantastic return. Okay, so we've got concentration, we've got deep research, and we've got this super rigorous valuation method. When you put it all together, what does it actually add up to? Let's look at the results and what I think is the single biggest lesson from the whole Glenn Greenberg method.
Well, the numbers kind of speak for themselves, don't they? From 1984 all the way to 2000. And remember, this was already one of the best bull markets in history. Greenberg's firm compounded money at an astonishing 25% per year. That absolutely crushed the S&P 500's already great 16%. That difference, compounded over that long, it's just a staggering amount of wealth creation.
But here's the real secret sauce. This is the key. It wasn't just that his winners were huge. Greenberg was the first to admit they made plenty of mistakes. The difference was that because of his process, buying great companies at cheap prices, his mistakes didn't kill him. His bad investments were just dead money that went nowhere for a while. They weren't fatal declines that could blow up the whole portfolio.
And that is the ultimate lesson here. The true power of this method isn't just being a genius at picking winners. It's having a system that's designed, first and foremost, to not lose catastrophically. By avoiding the big losers, his big winners were able to do their work and have this massive, undiluted impact on the final results. It all comes back to Twain, watch that basket.
So I'll just leave you with this question to chew on. We're all taught that diversification is the safe path, that it's a shield that protects you from what you don't know. But Glenn Greenberg's entire career suggests that maybe, just maybe, the riskiest thing you can do is admit you don't know and then scatter your money around anyway. Perhaps the real path to safety is the much harder path of concentration, the path that forces you to do the work and to truly deeply know what you own. Which one really sounds riskier to you?
You know, today we've got a story that isn't really just about stocks and bonds. It's about something deeper, mentorship, guts, and the kind of wisdom that lasts a lifetime. And it all starts in the middle of one of the worst economic disasters in history, with a young guy, a huge crisis, and believe it or not, a simple phone book. Let's dive in.
So let me ask you something. Put yourself in this situation. It's 1929. The world's economy is literally in a nosedive. You've just been handed an investment portfolio, but you have zero idea what to do with it. Who do you turn to? Who could you possibly trust when everyone, and I mean everyone, is losing their minds and their money? Well, for one young man, this wasn't just a hypothetical question. This was his life.
All right, so let's meet the main character in our story, Robert Heilbrunn. He's a student at the Wharton School, one of the best business schools in the world. His future looks pretty well mapped out. But a string of pretty awful events is about to chuck him into the deep end of a financial hurricane he is completely, utterly unprepared for.
I mean, just wrap your head around this timeline, all happening in a single brutal year. 1929. His father passes away. He has to drop out of Wharton to take over the family leather business. He's suddenly responsible for an investment portfolio, having never managed a dime. And then, the stock market completely self-destructs. Can you imagine the pressure? The entire future of his family was on his shoulders, right at the single worst moment to be in the market.
So Heilbrunn knows he's way out of his depth, right? He tries taking some courses at the New York Stock Exchange and NYU, but they're all just theory. They weren't giving him the practical, what do I do right now advice he was desperate for. And then he remembers a name his father had always spoken of with immense respect, Ben Graham. So in a move that sounds almost ridiculously simple today, Heilbrunn just looked him up in the phone book and made the call.
And you won't believe this. Graham actually agrees to take him on as a client. And the fee? A measly $25 a month. Even back then, that was a steal. Heilbrunn knew a bargain when he saw one, and that tiny investment was about to pay off in ways you could never measure on a spreadsheet. It was a call that changed everything.
Okay, so the stage is set. The mentorship begins, and man, right out of the gate, Graham hits Heilbrunn with a lesson that just goes against every piece of common sense at the time. This was his first test, and it was a big one. Okay, just look at this comparison. It's night and day. On one hand, you've got Heilbrunn's portfolio. It's filled with what any sane person would call safe stuff. High-quality utility bonds that are still paying out interest, a total no-brainer. On the other hand, you have Graham's pick, bonds from Fist Tire and Rubber, a company that was literally bankrupt. They were trading for 30 cents on the dollar. So Graham's first instruction is sell the safe, reliable asset and buy the junk. What would you even think?
Heilbrunn, and you can't blame him, is totally confused. He says, why would we sell them? They're good securities. And Graham's answer, this gets right to the heart of what value investing is all about. He says, exactly. And they will never be worth more than they are today. See, the lesson here is profound.
An asset being good or safe is useless if there's no upside. It's already priced to perfection. There's no room to grow.
And if that wasn't hard enough, it gets worse. Heilbronn calls his broker to make the trade, and the broker just straight up refuses. They actually said, "Our firm is too high class to deal in bankrupt paper." This just shows you the insane psychological wall he was up against. Following Graham wasn't just about numbers, it was about having the courage to ignore the entire financial establishment. In the end, Heilbronn had to fire the guy just to make the trade happen.
Well, spoiler alert, Graham was absolutely right. The Fisk tire bonds were a huge win. But this did more than just make Heilbronn some money. It was a complete transformation. He went from being a nervous, passive client to a hungry, active student of everything Graham did.
So when Graham drops his masterpiece security analysis, Heilbronn doesn't just read it, he dives in head first. He actually enrolls in Graham's night class at Columbia, and this is where it all clicks. He's sitting there in class, watching his own mentor dissect the financial statements of the exact same companies that Graham was buying for his portfolio. He was seeing the theory and the real-world practice come together right in front of him.
Now, Heilbronn really wanted to work for Graham, but there just weren't any jobs available. So Graham suggested something else: become an independent investigator for him. And you've got to remember, this is the pre-Google, pre-internet grind. We're talking about getting on the phone, actually going down to government offices, and literally digging through piles of dusty public records by hand, all to find that one little piece of information nobody else had. That's what it took to get an edge.
And all that shoe leather investing? It paid off, big time. In one case, he's digging into a little insurance company. You might have heard of it, it's called Geico. And he uncovers this obscure law. It turns out Graham's fund wasn't legally allowed to own a controlling stake in the company. Finding that was absolutely crucial. Because he found it, they were able to come up with a creative solution to distribute the shares. His hard work provided real, tangible value that saved them a massive headache.
So now, Heilbronn is armed with Graham's playbook and his own hard-won street smarts. He starts putting it all together, hunting for these amazing bargains hidden in the wreckage of the Great Depression. He learned to love buying what everyone else considered damaged goods.
Okay, let's break down one of these deals because it is just a masterclass. The famous Waldorf Astoria Hotel defaults on its bonds. The price for a bond that's supposed to be worth $1,000 collapses to just $300. That's already a great deal. But here's the genius part. Heilbronn discovers that Chase Bank will loan him $250 against each bond he buys. So his actual out-of-pocket cost was only $50 for a $1,000 asset. A few years later, the hotel gets back on its feet and the bonds are repaid, in full, plus all the interest they missed. Just an incredible, incredible investment. So over time, Heilbronn developed his own system. Think of it like a personal cheat code for investing. He would meticulously track a stock's own history, its price-to-earnings ratios, and its dividend payouts. By doing this, he could see, for that one specific stock, what was historically cheap and what was historically expensive. He wasn't comparing it to the market, he was comparing it to itself. It was a brilliant way to keep emotion completely out of the equation.
And why was that so critical? Because, as he put it himself, even a pro is subject to the same psychological pressures as everyone else. He knew how easy it was to get swept up in the hype, the bullish sentiment coming from Wall Street. His system was his defense mechanism against his own human nature.
And this all brings us to the final and honestly the most profound lesson from Heilbronn's entire life. After mastering the techniques, after building the discipline, he learned the most important thing of all, knowing your own limits. It all comes down to a really powerful idea in value investing called the circle of competence. The concept is simple, but actually living it is incredibly hard. It just means you have to be brutally honest with yourself about what you truly understand, and, just as importantly, what you don't. And then you stay inside that circle.
And this is where Heilbronn has this huge aha moment. He knew he was a good investor, but he also knew he was surrounded by people who were truly great, people who lived and breathed this stuff with a level of genius that was rare. People like his mentor, Ben Graham, his classmate, Walter Schloss, and another promising young guy from that circle, Warren Buffett. He realized the single best investment he could possibly make wasn't in a stock, it was in these people.
And this quote right here, this is the mic drop moment. Knowing when other full-time investors are likely to outperform your own part-time efforts may be the most fundamental of all value insights. He figured out that the smartest thing he could do was use his skill to identify genius in others and then bet on them.
It's an incredible lesson in humility and in strategy. It's about knowing yourself. So the final question isn't just, what do I know? It's, who do I know that knows better?
All right, today we're pulling back the curtain on one of the greatest and maybe one of the quietest investors out there, Seth Klarman of the Baupost Group. We're going to dive deep into his playbook, figure out how he thinks, and see how his risk-first philosophy helps him find these incredible opportunities that almost everyone else just walks right past. You've probably heard this quote before, right? It's classic Buffett. But for Seth Klarman, this isn't just a catchy phrase you put on a poster. It is the absolute, non-negotiable foundation of everything he does. He is obsessed with the downside, with the potential for losing money, long before he even starts thinking about how much he could make. It's a discipline that served him and his investors incredibly well for decades. So here's our game plan. First, we'll unpack that #1 rule and his idea of a margin of safety. Then we'll go on the hunt for what he calls motivated sellers. This is where the real magic happens. After that, we'll see how he finds investments that don't need the whole market to go up. We'll touch on his bottom-up approach, and then we're going to wrap it all up with an amazing case study, his massive bet on Texaco. Okay, let's really get into that foundation. For Klarman, don't lose money isn't just about being cautious. It's the entire point. He believes value investing is pretty much the only strategy that truly protects you on the downside while still giving you a shot at some really fantastic returns. This isn't about being scared. It's about being incredibly, relentlessly disciplined. Now, margin of safety, that's value investing 101, straight from the Ben Graham playbook. The idea is simple. Buy a dollar for 50 cents. But here's what's so interesting about Klarman. For him, it's not about a margin of safety. It's about having multiple margins of safety, all layered on top of each other. He wants to see an investment that's cheap from, well, almost every angle you can look at it. He's looking at the price compared to its assets, its earnings, its cash flow, but he's also looking for other signs, right? Are the people running the company buying their own stock? Is the company itself buying back shares? The whole idea is that if one part of your thesis doesn't work out, you've got all these other layers of value there to catch you. And this quote just perfectly captures his philosophy. Think about it, right? A belt works fine. Suspenders work fine. But if you're wearing both, you've got an incredible amount of security. That's exactly what he wants in an investment, that redundant protection. He wants hard assets and strong earnings. That's the ultimate cushion. So if you're trying to find these assets with a huge margin of safety, where do you even begin to look? Well, Klarman's answer is surprisingly simple. You look for situations where people are being forced to sell for reasons that have absolutely nothing to do with the actual value of the thing they own. This is the key. This is the inefficiency he's built a career on exploiting. A motivated seller isn't dumping a stock because they did a deep dive and think it's overvalued. Nope. They're selling because some rule book says they have to, or they're in a panic and need cash right now. Their reason for selling is pure compulsion, not a rational financial decision. And you know, these situations are all over the place if you just know what to look for. Think about when a stock gets kicked out of the S&P 500. All the index funds have to sell it, period. They don't care about the price. Or when a huge company spins off a tiny little division. The big mutual funds that own the parent company might just dump the new tiny stock because it's too small for them to even bother tracking. It's basically a fire sale, and the disciplined buyers can just swoop in. Let me give you a perfect example. There was a company called Venator. It was the old Woolworths, actually. When it got dropped from the S&P 500, the stock just got annihilated. It was literally cut in half, dropping from about $6 to $3 in a matter of days. And why? Not because the business was suddenly worth half as much. It was simply because all those index funds were forced to sell at any price. And the result for a patient buyer was just stunning. Less than 3 months later, the stock was trading at $10. That's the power of finding a motivated seller. Okay, so you found a cheap asset that was dumped by a motivated seller. Now what? A lot of investors would say, well, now you wait for the market to come to its senses. But Klarman isn't a fan of just sitting around and hoping the market agrees with him. He doesn't like being dependent on what Ben Graham called the fickle Mr. Market. And this is a really important distinction. Klarman's goal is to generate positive, absolute returns. He's not just trying to beat the S&P 500. To do that, he needs investments that have their own internal clock, their own path to paying out. He wants a built-in catalyst that's going to unlock the value, whether the rest of the market is soaring, crashing, or just going nowhere. So what do these things actually look like? Well, think about buying the bonds of a company that's in bankruptcy. Your return has nothing to do with the Dow Jones. It's all about what happens in the courtroom. Or picture a company that's liquidating. It's shutting its doors and selling off everything.
the payouts to investors happen based on the company's own wind-down schedule. These investments just march to the beat of their own drum.
So this all leads us to how he actually analyzes these opportunities. Klarman is a true believer in the bottom-up approach. He's not sitting around trying to predict what the Fed's going to do or what GDP will be next quarter. No, he starts with one single company and builds his case from the ground up.
The difference here is huge. Top-down investors, they try to guess the big picture first. They'll say something like, oh, the economy is heading for a recession, so I should sell stocks. Klarman's view is that it's just so much easier to be right about a single business than it is to be right about the entire global economy. He'll find a stock he thinks is a bargain, and if the price goes down, he just rechecks his work. If the business is still solid, he sees it as an even better chance to buy more.
And what's really powerful about this bottom-up method is that it allows him to find these repeatable templates. Once he does all the hard work to understand one very specific type of situation, he can take that same playbook and use it again and again on other similar companies. The perfect example of this was the wave of thrift conversions back in the early 90s.
Okay, let's walk through this. It's pretty simple. You've got your sleepy local savings and loan. It's owned by its depositors, not shareholders. It has $100 million in assets, $90 million in liabilities, that's mainly just people's savings accounts, which leaves $10 million in equity or book value. Simple enough. But now watch what happens when it converts and goes public. The bank gets appraised and is told it's worth its equity, so it sells $10 million worth of stock to new investors. But that $10 million in cash doesn't go to the old owners, it goes straight into the bank's own accounts. So look at the balance sheet. The equity instantly doubles to $20 million. The new shareholders just paid $10 million for a piece of paper that's now backed by $20 million in equity. They basically bought their own cash back and got the entire bank for free. It was an incredible, repeatable setup that Klarman used over and over. All right, let's put this all together. We're going to look at a final case study that is just a masterclass in Klarman's thinking. This is one of his biggest investments ever, the Texaco bankruptcy, and it perfectly combines motivated sellers, a lack of other buyers, and a really deep bottom-up analysis of risk. So here's the story. Back in 1987, the oil giant Texaco lost this huge lawsuit to Pennzoil and got slapped with an insane $11 billion judgment. Now, to appeal that verdict, they would have had to post a bond for the full amount, which would have been crippling. So to avoid that, Texaco, a huge profitable company, actually filed for bankruptcy. It created absolute chaos in the market, and that's where Klarman saw his chance. He started buying Texaco bonds for around 90 cents on the dollar. Now, just look at the simple math that he saw. He's paying about $90 for each bond. But because Texaco was in bankruptcy, it had stopped paying interest, but that interest was still being racked up. It was still owed to the bondholders. So on top of the $100 principal, there was already another $18 in back interest owed. His total claim is for $118 on an investment of just $90. And as it turned out, Texaco settled the case just 9 months later. The bonds were paid in full, and he walked away with a return of well over 30%. So you have to ask, why was this incredible opportunity just sitting there? Well, first, you had motivated sellers. A ton of big institutions had rules in their charters that said they couldn't own defaulted bonds. The second Texaco missed an interest payment, boom, they were forced to sell no matter the price. And second, you had absent buyers. A lot of the usual distressed debt funds actually stayed away because they were worried the bankruptcy might drag on for years and the return wouldn't hit their crazy high targets. And this, right here, this is the most important lesson. Klarman understood exactly what kind of risk he was taking. He knew that Texaco, as a business, had way more than enough assets, oil fields, refineries, you name it, to pay back all its debts even after a huge settlement. There was almost zero risk of not getting his money back eventually. That's credit risk. The real risks were process risk, how the bankruptcy court would handle things, and timing risk, how long it would all take. For a patient investor who could live with that kind of uncertainty, it was an incredibly high-return, low-risk bet. When you boil it all down, Klarman's genius really comes from his incredible discipline and his focus on finding value in these messy, complicated, unpopular corners of the market that scare everybody else away. And that really leaves us with a big question to think about. In today's world, where information is instant and it feels like money is chasing every single deal, where do those uncrowded spaces still exist? Where are today's motivated sellers? All right, let's talk about a Wall Street legend who didn't just play the game. He basically wrote his own rule book.
This is the story of Michael Price, a guy who forced the market to play by his rules. I mean, seriously, how do you do that? It sounds impossible, doesn't it? But back in 1995, one investor saw a financial giant, a household name, making what he thought was a terrible mistake. And he decided, nope, not on my watch. He wasn't going to sit back and let it happen.
So who was this guy? Michael Price. He was a value investor through and through. But he wasn't your typical buy and hold manager who just waits patiently. No, Price believed that if a company's management wasn't doing its job, you had a right, heck, maybe even a duty, to step in and force them to unlock the value they were ignoring.
And his target in this case? None other than Chase Bank. Yeah, that Chase, a pillar of American finance. But where everyone else saw a respected institution, Price saw a company that the market totally misunderstood. And worse, he saw a management team that he believed was actively destroying value for its owners, the shareholders. So what did he do? He didn't just write an angry letter. He went out and bought over 11 million shares of the bank. Now let that sink in. This wasn't a token position. This gave him more than 6% of the entire company. He became a voice that, legally, management could not ignore. See, Price had done his homework, and his numbers showed that Chase stock was trading for a massive discount to what it was actually worth. His goal wasn't just to make a quick buck for his fund. It was to force management's hand and close that value gap for every single person who owned a share of the stock. So how did he pull it off, and what can we learn from his playbook? Well, we're going to break it all down. We'll look at the man who fought giants, his risk-first philosophy, his all-weather portfolio, how he hunted for that hidden value, how he became his own catalyst for change, and finally, the 4 virtues that guided his entire career. This whole battle with Chase is really a perfect story of what we call activist investing. Price understood that owning that much stock didn't just give him a piece of the profits, it gave him real power. It gave him a lever he could pull to force change. But to really get why Price had the guts to do this, you have to go back to the beginning. His entire worldview wasn't shaped during some easy, breezy bull market. Oh no, it was forged in the fire of one of the absolute worst market crashes of the 20th century. Imagine starting your career right in the middle of this. In the mid-70s, the market just fell off a cliff. The Dow dropped by 40% in 2 years. It was an absolute bloodbath. Fortunes were wiped out, and an entire generation of investors learned a very, very painful lesson about taking risks. Now, just look at this chart. It's incredible. While the broad market was getting absolutely hammered, the fund price was at mutual shares was basically a rock. It lost a tiny bit one year, made it right back the next. Over those 2 catastrophic years, the fund was pretty much flat. It just showed the immense power of playing defense. And that experience just seared a lesson into his brain, one that became his golden rule: lower the risk first. He realized that if you can just avoid losing a ton of money when everything hits the fan, you don't even have to be a hero in the good times to end up way ahead of everyone else over the long haul. And this risk-first idea wasn't just some nice-sounding quote he put on the wall. He literally built his entire portfolio around this principle. He created what you could call an all-weather portfolio. Here's a look at how he set things up. About 2/3 would be in what he called cheap stocks. We'll get to that in a sec. But it's the other third that was his secret weapon. It was made up of alternative investments and cash. Things that didn't really care what the stock market did on any given day. So what was in that alternatives bucket? Well, a big piece was bankruptcy investing. Price would go in and buy the debt of struggling companies for pennies on the dollar. Whether he made money or not had everything to do with lawyers and judges in a courtroom, not with whether the Dow was up or down. He was playing a totally separate game. Another trick he used was called risk arbitrage. You know, when one company announces it's buying another, well, there's usually a small gap between the stock's price today and what it'll be worth when the deal closes. Price would jump in and capture that small, predictable profit. It was just another way to earn a steady return that had nothing to do with market chaos. Okay, so that's the defensive part of the portfolio, but what about that big 66% slice, the cheap stocks? How on earth did he find those? Well, it all boiled down to one thing: ignoring all the noise and doing more homework than anyone else. Let me give you a perfect example of how his brain worked. Let's talk about General Electric, back in the year 2000. At the time, GE was the king of the world. Everybody loved them. But Price looked at the sky-high stock price, and he was skeptical. He just didn't buy the hype.
So instead of just looking at GE as one big company, he did what a smart business owner would do. He took it apart, piece by piece. He looked at aircraft engines, plastics, appliances, every single division, and he put a realistic price tag on each one, asking what would a rational person actually pay for this business? And this is where he uncovered the truth. After he valued all the real, physical businesses, he did the math and realized that for GE's total stock price to make any sense, Wall Street was valuing its financial arm, GE Capital, at over 70 times its earnings. 70! To Price, that wasn't a real number. That was just, as he called it, Wall Street magic, pure hype.
You see, when you do that level of homework, you're not just guessing, you know? You build this rock-solid conviction. And it's that kind of conviction that gave him the confidence to not just buy a stock like Chase, but to actually take them on and tell them how to run their business.
So here's the playbook he ran. Step 1, he found the discount. His work showed Chase was trading for half of what it was worth. Step 2, he built his massive stake. Step 3, he went public, putting management on notice. Step 4, he got other big investors on his side. And Step 5, the final move, he forced them to merge with Chemical Bank, a move that unlocked billions in value and proved him right all along. So when you boil it all down, the market crashes, the deep research, the activist fights, Price's whole approach really comes down to 4 core principles, 4 virtues that he lived by. First, discipline. You have to stick to your guns on what something is worth and never overpay, especially when everyone else is losing their minds. Second, patience. You do the work and then you wait. You let the opportunities come to you. Third, focus. Forget about predicting what the economy is going to do. Just focus on the one business right in front of you. And last, but most important, homework. You have to know more about what you're buying than the person who is selling it to you. End of story. And really, his entire career leaves us with a huge question for today. We live in a world where we're just drowning in information, headlines, and noise. In this kind of world, is the simple old-fashioned discipline to just shut it all out and do the deep homework, is that the only real advantage any of us have left? Something to think about. Thanks for joining us.
You know, in the world of investing, we're always being sold on complexity, right? High-speed trading, these dazzling algorithms, strategies that are so complicated, you'd think you need a PhD to figure them out. But what if I told you that one of the greatest, most consistent track records in all of history belonged to a guy who did the exact opposite? Today, we're going to dive into the story of Walter Schloss. He's one of investing's quietest, but man, one of its most profound legends.
All right, first things first. To really get a handle on the genius of Walter Schloss, you've got to understand the sheer scale of what he pulled off. I mean, we're not just talking about a good run for a few years or, a hot decade. No way. We are talking about a dominant, market-crushing performance that went on for nearly half a century. Just take a look at this. This one chart, it tells you pretty much everything you need to know. That dotted line, kind of chugging along at the bottom, that's the market, the S&P Industrial Index. And that solid black line, just soaring into the stratosphere way above it, yeah, that's Walter Schloss. It is just a stunning picture of what happens when unwavering patience and discipline go toe-to-toe with the market average over the long, long haul.
Okay, so let's put some hard numbers to that chart, just so you can really feel the difference. Imagine you invested just $1 single in the S&P index way back in 1956. By the year 2000, it would have grown to $118. Not bad at all, right? That's a solid return.
But here, this is where the story gets absolutely remarkable. That same single dollar, if you'd given it to Walter Schloss over that same stretch of time, would have turned into an incredible $662. That's not just a little bit better, it's a staggering, honestly, a life-altering difference. And it all comes down to a very specific, very disciplined way of thinking.
Now, you might be thinking, okay, to get those kinds of massive returns, the guy must have been taking some wild, high-flying risks. But the numbers tell the exact opposite story. He compounded at 15.3% a year. That's almost 4 full percentage points better than the market's 11.5. But now look at the risk side. Over 45 years, he only had 7 down years. The market had 11. And when he did have a losing year, his average loss was way smaller. I mean, just let that sink in. He delivered higher returns with lower risk. That basically spits in the face of a core idea of modern investment theory.
So,
The million-dollar question is, how on earth did he do it? What was his secret sauce? Well, the secret, as it so often does in the investing world, starts with his mentor, the legendary father of value investing himself, Benjamin Graham.
Schloss's journey is just incredible. It started back in 1934. He was just a teenager, 18 years old, starting out on Wall Street right in the middle of the Great Depression. Can you imagine the lessons that kind of environment teaches you? So he starts taking these night courses with Benjamin Graham, just soaking up all his ideas. After serving in World War II, he comes back, and Graham actually hires him. By 1955, Schloss was ready to go out and apply those lessons on his own. And let me tell you, that foundation in Graham's principles, it wasn't just part of his story, it was everything. Graham taught him what is arguably the single most important concept in all of value investing. It was the North Star for his entire strategy, the margin of safety. Okay, think of it like this. Forget trying to guess how much a company is gonna earn in the future. Just forget it. Instead, focus on buying its tangible stuff, its factories, its cash, its inventory, for way, way less than what it's worth right now. That discount, that gap between the price you pay and the actual value, that's your built-in protection. It's your shield against bad luck, bad markets, and even your own mistakes. It's the cushion that lets you be wrong and still come out okay.
And you can tell, Schloss just deeply admired his mentor. And it wasn't just about the financial success. It was about the sheer power of Graham's ideas. He saw Graham as this true intellectual, someone who was more interested in the puzzle of finding value than he was in just getting rich. And that whole mindset, focusing on the process instead of just the prize, it definitely rubbed off on him.
Okay, so Schloss takes this incredibly powerful foundation from Graham and he builds his own code on top of it. It's simple, it's repeatable, and it's almost stubbornly consistent. This was the system that guided every single investment decision he made for over 4 decades.
And whenever reporters or even his own partners would ask him to explain his incredibly successful market-beating strategy, his answer was always the same. He'd just say, "We buy cheap stocks." That's it. It sounds so deceptively simple, it's almost funny, right? But it was 100% true. Everything else was just a detail. This was the core.
And these core principles, they formed a complete system. And it wasn't just about investing, it was about emotional discipline. See, he focused on assets, because earnings can jump all over the place, they can be manipulated, but a factory is a factory. He went shopping for bargains on the new lows list. That's where everyone else is panicking and dumping their stock. He was patient, holding things for an average of 4 years, giving his ideas time to breathe. He diversified like crazy, sometimes holding 100 different stocks, because he knew some of these ugly ducklings just weren't going to work out. And maybe most famously, he refused to talk to company management. He didn't want to get charmed by some slick CEO. He trusted the cold, hard numbers on the page. And that's it.
And this was his guiding faith, his mantra, really. He just fundamentally believed that if you bought $1 worth of stuff for 50 cents, you didn't need a crystal ball to figure out what was going to happen next. Something good would happen. Maybe the market would realize its mistake, maybe a competitor would buy the company, or maybe the business would just fix itself. With that huge margin of safety, time was always, always on your side.
So that's the theory, and it sounds great on paper, right? But what did this actually look like in the real world? Let's dig into a couple of real-life examples of the Schloss Code in action.
All right, let's take a look at the copper company Asarco. Back in 1999, the business was in big trouble, and its stock was getting absolutely hammered. But Schloss? He just ignored all the scary headlines and looked at the numbers, at the balance sheet. He saw that the company's assets were worth about $40 a share, but he could buy the stock for less than 15. I mean, that margin of safety was just enormous. He didn't need to predict when copper prices would go up. He just had to wait. And sure enough, another company saw the exact same value he did. A buyout offer came in, and he nearly doubled his money. All by just buying cheap stuff and waiting for everyone else to catch up.
Here's another perfect example. Remember the year 2000? Food stocks were totally out of favor. J.M. Smucker, a rock-solid company with a fantastic brand, saw its stock price crater from nearly $40 all the way down to below $15. At that price, it was selling for just 10 times its earnings. For Schloss, that was a no-brainer, an obvious bargain for a quality business. So he bought in. And guess what? Just 7 or 8 months later, the market came to its senses and the stock shot back up to $25. No complex analysis needed, just a cheap price for a good company. Simple.
But, and this is absolutely key, his discipline also meant knowing when to sell. He famously bought Lehman Brothers at $15 a share, way below its book value.
When the stock recovered to 35, it wasn't cheap anymore by his strict rules, so he sold. Now that stock went on to pass $130 a share. So did he miss out on huge gains? Oh yeah, absolutely. But you know what they say? The money he left on the table bought him a good night's sleep. He never ever broke his own rule. Buy cheap and sell when it's no longer cheap. End of story.
And this brings us to what might be the most remarkable part of the whole Walter Schloss story. And honestly, I think it's the most important part. It wasn't just about the amazing returns, it was about how he got them. And even more than that, how he treated the people who trusted him with their money.
You know, even Warren Buffett, who was another one of Graham's students, was a huge admirer. He once wrote this great line about Schloss's super minimalist setup: just a small office, no fancy computer, only a monthly stock guide for his data. And Buffett said, with just those simple tools and his simple philosophy, he went out and did battle with the S&P and just crushed it year after year after year.
And his integrity just shines through in how he set up his partnership. I mean, it was almost unheard of back then, and it's still pretty rare today. For starters, he took no management fee. He only got paid if his partners made money. That's it. If the fund lost money in a given year, he personally paid his share of that loss right out of his own pocket. He automatically paid out gains to his partners instead of just holding on to their money to grow his own fees. He even kept his portfolio a secret because he knew his partners would freak out if they saw the list of ugly, beaten down, totally out of favor companies he was buying. His entire business was built to perfectly align his interests with his clients and, above all else, to never ever lose their money.
You know, when you look at Walter Schloss's incredible 45-year record, it forces you to face this really powerful and maybe even a little uncomfortable question. In an industry that is constantly screaming at us that we need more data, more speed, and more complexity, maybe the greatest, most enduring advantage of all is just disciplined simplicity. Maybe it's just having a sound philosophy and the unwavering guts to stick with it no matter what. It's something to think about, isn't it?
Have you ever thought about it? Finding that one hidden gem, a real diamond in the rough, in a company that everyone else has just completely written off? Well, today, we're diving into the story of an investor who does exactly that, and in the process, uncovers one of the most remarkable turnarounds you'll ever hear about. Just think about this for a second. You put your money into a company, and in a little over a year, your investment multiplies 5 times over. That's a 500% return. I mean, that's the stuff of legends, right?
But here's the real kicker. This wasn't some hot new tech darling. No way. This was a company that had been dragged through the mud, a massive accounting scandal, delisted from the stock exchange, basically left for dead. And all this happened while the broader tech market was in a free fall, with the NASDAQ dropping 15%. How on earth is that even possible? That's the mystery we're going to solve today.
So what's this company? The company at the very heart of this incredible story is Centennial Technologies. Back in the late 90s, that name was basically poison, synonymous with failure. But you know, as they say, one person's trash is another's treasure. I mean, look at this list. It's just brutal. A massive accounting fraud, the stock plummeted. Lawsuits, you bet. Kicked off the stock exchange. You know, for all intents and purposes, everyone just assumed they were out of business. This stock was radioactive. So the question is, who in their right mind would even look at it? And that's where our hero, the value hunter, comes in. His name is Paul Sunken, and he's the guy who saw what everybody else missed. Now, Sunken isn't your typical trader chasing the latest hot stock. No, his approach, it's rooted in something much older, much more disciplined.
Yeah, Sunken is a true student of the game. You could call him a modern-day disciple of the one and only Benjamin Graham, the guy who literally wrote the book on value investing. I mean, his resume is legit. Columbia Business School, where Graham himself taught, the SEC, Goldman Sachs. This guy lives and breathes this stuff. He's all about finding real, tangible value, not just chasing hype.
So what's his secret sauce? It's right here. In a market that is just obsessed with growth, with big, exciting stories, Sonkin does the exact opposite. He's not staring at future earnings projections. He starts with the balance sheet. He's looking for cold, hard assets, especially cash, and he does his hunting in the small cap and micro cap world. You know, the dusty corners of the market that the big funds just ignore. Why? Because that's where you can still find these cash-rich companies that are just dirt cheap.
Okay, so let's get into the nuts and bolts. How does he actually find these companies? Well, Sotkin has this specialized toolkit for sifting through what's basically the market's bargain bin. It really is all about knowing where to look and what you're looking for.
One of his favorite hunting grounds is what he calls a broken IPO. And you know exactly what this is, right? A company goes public, there's a ton of hype, the stock shoots for the moon, but then, boom, reality hits. Growth isn't what they promised, the story falls apart, and the stock just craters. For those early investors, it's a total disaster. But for a guy like Sonkin, that's the dinner bell ringing.
And this chart, it's the perfect picture of a broken IPO. Just look at this company, SCC Communications. It goes public in mid-98, spikes up to almost $16 a share, and then, the hype just vanishes. As you can see, the stock completely collapsed, falling all the way below $4. And that moment, right there, that moment of maximum pain and pessimism, that is exactly where Sonkin gets interested.
And here's the play-by-play of how he handled it. He starts buying in March '99, right after that huge crash. He saw that SCC, which provided telecom services to inmates, of all things, had a really solid recession-proof business that was just getting unfairly hammered, so he was patient. Later that year, some legislation passed that actually helped the company. Then, fast forward to early 2000, the whole dot-com bubble is in full swing, creating this new wave of craziness, and the stock shoots right back up past $16. But Sonkin, being the disciplined value guy he is, he doesn't get greedy. He sells right into that frenzy. Classic. He bought the fear and sold the greed.
Now, to find a company like SCC, you need a very specific tool. Sonkin uses this metric called the capitalization rate, or cap rate. And here's a simple way to think about it. Instead of just looking at a PE ratio, the cap rate tells you what you're really paying for the actual business after you factor in all the cash it has sitting in the bank. It's a secret weapon for spotting companies that might look pricey on the surface, but are actually incredible bargains because they're just sitting on a mountain of cash.
All right, so let's bring it all back home. We're returning to our original mystery, Centennial Technologies. Let's see exactly how Sonkin took this value hunter's toolkit and applied it to this company that everyone thought was completely worthless.
His process here was so methodical. This wasn't a gut feeling. First, he just stumbles upon it on a list of stocks hitting new lows. He was probably surprised it was even still trading. Second, he does a really quick back-of-the-envelope calculation using that cap rate idea. Third, he does his homework. He verifies the numbers, checks out the new CEO, and actually picks up the phone and calls the CFO. And finally, with all that info, he calculates what he believes the company is truly worth.
Okay, now this is the slide. This is the math that must have made his jaw drop. The entire company was valued by the market at about $12 million. But get this, it was sitting on over $11 million in cash and securities. So the effective price he was paying for the actual operating business was less than $1 million. And what did he get for that tiny price tag? A business that was earning $1.3 million. I mean, think about that. He could buy over $1 million in earnings for under $1 million. That's not a bargain, that's a steal.
So Sonkin starts buying. But, every great value investment needs a catalyst. That one event that just forces the rest of the market to wake up and see the company's real worth. For Centennial, that catalyst came on December 30th, 1999. The company put out a press release saying it was buying a business unit from Intel. Friggin' Intel. This was a massive vote of confidence, a total game changer.
Sonkin, of course, immediately reruns his numbers. This Intel deal would boost earnings right away. His new estimate for the company's real intrinsic value jumped to over $6 a share. Now, at the time, the stock was trading around $4, so his margin of safety, that critical cushion between the price and its value, was still really, really good. He knew he had to move fast.
And this is what happened next. It's just wild. Sonkin buys more shares right when the market opens, at $4.63. Then he leaves for an appointment. By the time he gets back to his desk around 1:30 in the afternoon, the stock had just exploded to $9. In a matter of hours, the market woke up and pretty much ate up his entire margin of safety. Just like that.
But hold on, the story isn't over yet. Sonkin sold some of his shares, but smartly held onto a core position. And man, was that a good move. About a year later, January 2001, a bigger company called Selectron comes in and buys Centennial outright for $21 a share. 21. So, from that $4 price where he first got interested, all the way to the final buyout, that five-fold increase was complete. Just incredible.
So here's a really crucial point. This kind of investing isn't about making one single Hail Mary bet. It's about building a whole portfolio that can handle whatever the market throws at it. Sonkin doesn't just hunt for these individual bargains, he builds what I'd call an uncorrelated fortress. And here's how he does it. He literally splits his entire portfolio into two completely different halves. On one side, you've got his general portfolio, which is where he puts those deep value, forgotten stocks like Centennial. But on the other side, he runs arbitrage operations.
And these two sides are designed to balance each other out perfectly. The arbitrage half, that's all about short-term corporate events like takeovers, where the outcome is pretty predictable. You know, if company A says it's buying company B for $10 and B is trading at $9.80, the arbitrageur buys it to lock in that small, high-probability 20 cents. It's a way to generate steady cash. The general portfolio, on the other hand, that's for the long-term holds like Centennial, where you don't know when the catalyst will hit, but you know the value is huge. And because these strategies are so different, they don't move together with the market, which drastically lowers the overall risk of the whole portfolio. It's a brilliant setup. So, when you step back and look at this incredible story, what's the real lesson here? In a world that's obsessed with speed and hype, what is the value investor's actual edge?
I think it all comes down to this quote from Sonkin himself. The edge? It's not just a fancy spreadsheet or some secret formula. It's the discipline to go looking where nobody else is. It's the patience to wait for the right price. And yeah, it's the courage to buy when everyone else is screaming sell. It's all about finding the beauty in a stock when it looks its absolute ugliest. And as Paul Sonkin proves, it's not just a profitable way to invest. It can also be a whole lot of fun.